You would know me to rest. Wow. Good evening, everyone. Please, can you hear me?
Good evening, sir.
Good evening, good evening, good evening.
Good evening, sir.
Mr. Omar, good evening. You back?
How are you, sir?
I'm fine. I'm managing my life. As you would know me to rest now. There's no rest for the wicked.
Don't worry, but after May, you rest.
After me, I will not rest now. We'll still do training. So I will still not rest.
What kind of training is that?
Don't worry, hear about it when the time is due. We do accounting software after the diet. So I'm sure
I'll
you
be
hear.
interested.
Anyways, let's get to the business of today. First of all, I have three announcements. I have three things to say, or three announcements. Let me put it like that. The first one I would like to say is, let me just apologize first. I'm very sorry for not attending to most of the assignments that were sent to me. Very, very sorry. It was a very, very long week. The week was very, very long. I'm very sorry. Although I looked at about 1 or 2 or 3 anyways, but I'm very sorry I was not able to look at majority. But I would run them through and I will compare and I will tell you I would check and I will tell you what the answers are so you can compare what you did. And if you did not get or if you do not get it correctly, I would advise maybe you try it again. If you still do not get it, you can reach out to me. Then I'll be able to help like that. So please and please and please, very sorry for not looking at for not attending to the assignment. Very sorry, very stressed, very sorry. That's number one. Number two, I'm intentionally not going to record this anyways. Number two, please, this is off the books. Not off the books, but it's not particularly off the books. So this is what happened. Normally, for the past 1 or 2 diets, I don't take personal classes. Like, I don't take personal classes. Students used to reach out to me to come and do personal classes, but I don't have the strength and the time and the energy. I'm not even going to lie. So I'm not used to doing personal classes or private classes. Let me call it private classes. I'm not used to do private classes. But something funny happened last diet. So last diet, when it was close to exam, I think when it was about 3-4 weeks to exam, about 6, I think there were a couple of friends. So about 6 or 7 students reached out to me that I should just do revision and all those things for them. But apparently, because I was already almost done with my lecture, so I feel like I had time that time, and I felt like okay, something I wanted to do, and it was close to exams. So I'm like, okay, it's just revision, and some of the topics I did not take, so I had to revise some of them with them. I think there were about 7, then about 2 people later joined us. So I think we were about 10 that did that revision class, and we studied together for about 3 weeks, and believe me, about 8 of them. 8 or 9 actually passed. One that did not pass did not later write the exam. Okay, one did not pass. I think he did not pass. Then one person did not write the exam. Then about 8 out of the 10 students actually passed. And for me, 8 out of 10 is a win. Or let me just say 9 out of 10 is a very, very big win for me. So that's by the way, anyways. So for this diet, about 3 women, I don't know if they're in this class, they've been chasing me since day one. They're not after my life. Don't let me say they're after my life. But they are literally at my back. They've been chasing me around for private classes since. But because of my schedule and because of my time, and I really did not want to take it, or I really do not want to take the private class. But with the way this woman was very persistent, I decided to consider it. Just consider. So I decided to consider the class. Anyways, what I'm saying is, why I'm saying this out here is that, they don't bring my light. Oh, anyways, what I'm saying is, why I'm bringing this here is that, Mr. Isaiah, now I know when you enter this class. Why are you laughing now? Because they brought my light. Oh, wow. Anyways, so as I was saying is, what I'm bringing this here is that, like I said, I do not like. It's just okay. Let me just say what I'm saying. So I'm saying this here because I do not want a lot of students. Please listen to me. It's supposed to be private, but I do not want a lot of students. But I still do not want some people to lose or how would I say, to not be able to, it's different if you don't know. But I just want people to have the information. It's not, if you don't know, it's a different ball game. I just want people to have the information. Please, there are still, I think about, I don't want a very, very big number. About 2 or 3 slots are still open. 2, 3, I think about 2 or 3 there, but I'm not particularly sure. So about 2 or 3 slots are still open for the private class. What I'm saying is, please, if you are interested, you can just reach out to my private line. Don't reach out to my business line. You can reach out to that. That's the number you submit your assignment to. Just say your name and just say you are interested in the private class so that I can reply or so that I can check or answer you on time, because we're planning to start classes this week. And another thing why I'm actually planning to, why I really want to take these private classes, there are some topics that, believe me, even me myself, I'm not, even all the lecturers, there are some topics that you will not, how would I say it? It's not as if you don't know them, but you are not particularly very conversant because you don't deal with them on a day-to-day basis. So there are some topics that I feel like I've not been looking at in the recent times. So it's one of those why I decided to take the class, so that at least it would be as an advantage for me to also go and look at those topics and be on a very, very good level. So what I'm saying is, if you feel like you are in a very, very constraint, it's not going to affect my classes. Oh, my classes are still going to be normal. It's not even going to even get tough herself, because as we are moving forward, time here, so it's not going to affect my classes whatsoever. But if you feel like you are interested, you can reach out to my other number. Please, somebody should please type that number in the comment section. Even me, I don't know the number offhand. I know some of you know that number offhand. Me, I don't know it offhand. So if you know it, please help me type it in the comment section. So please, you can reach out to that number. Just say your name and let's say you are interested. I think about 3 slots. Please, I don't want plenty students. About 10. My target is even 10. I just want 10. Then 10, I'm done. So please, you can reach out. Just say your name and say you are interested. Thank you very much. That is
Interested in what, sir? Please, sir, I'm just joining in.
That's it, Daji. Hey. So what I'm saying is, I said that, oh God of mercy. So I'm planning to take a little bit of private class. Some students are at my back. So I have about 2 or 3 slots available. So I'm just putting it out there if you are interested, so that you have the information. It's different that you don't say, Mr. Ashley, why didn't you tell us this one, that one? So I'm just putting it out there that I have about 2 or 3 slots left. So if you are interested, it's just about 10 students I want, please. I don't want stress for my life. It's just about 10 students. So what we will just do with the we'll just what am I saying? So we'll just majorly solve past questions. But anyways, when we get there, we'll talk about that. Anyways, so the number is on the group chat. Just text the number. Just say you're interested in the private class, then we can pick you up from there. Please and please, this is off the books. This is not Apex or anything. This is just personally me. And it's because of the students that are at my back. Normally, I don't even do private classes. I like to rest in the days I don't teach. But with the private class now, it means that most of the days now I will be teaching. So that's why I do not like to take it. But I don't know. I'm feeling generous this diet, anyways. So that is that for that. Please, you can text me, and it comes with a fee. I beg, don't let us be thinking. Anyways, when we get there, we'll settle down. So let me start with the business of today. We have a lot of things to do today. So please, the number is on the comment section or in the comment section. Please, you can see it and text me on WhatsApp. Mr. Isaiah, thank you. This man, are you stalking me? You know my number offhand. Please, it's women that are supposed to be knowing my number offhand, though. No be man. The women are
What's
supposed
the
to be knowing
number,
my number
please?
offhand. Yeah, the number is already in the comment section. I don't know why Mr. Isaiah will be knowing my number offhand. What is that? Abego.
I'm just a brother's keeper, sir.
Don't keep me. Why are you your brother? Don't keep me. Oh. Avoid me. Avoid me, please. Anyways, that's two announcements I've made. There's still one more, but this last one I want to keep it on record. So please, 1 minute. Let this thing start recording. Hmm. 1 minute, please. I want to start the recording of the class. This recording that's what we are waiting for. No alarm. This is just about 2 or 3 slots. I have all these. I'm interested. I'm saying. I better go. I'm waiting for the recorded classes to start. Then we can fire on. Please, what was the assignment I gave, please? Okay, the recording has started. So let me just make the final announcement before we get to the work of today. So the final announcement I want to make is still about me. So please, I'm saying this everywhere so that you guys will know what we do as a company. Please, if you are in your workplace or wherever you are and you feel like maybe you guys need accounting softwares or whatever, so we actually do installation of accounting softwares, whichever accounting softwares you want, anyone, from QuickBooks to Sage to ZooBooks to Odoo to anyone, any accounting software you want. So you can reach out to that same number, please, so that we can. I just finished. It was one of you. That's why I actually remembered. I just finished one transaction with one of my students. I don't know if it's on this class or if it's in this class. We just finished one transaction with one of students from this. So I just decided to bring it here in case anybody also has a company that wants to install accounting software. Please reach out to us. At least you people can do that for me now. At least at all I'm back. So please reach out. Then we can work on that together. So I decided to put that on record so anybody that is streaming on YouTube or anybody that is watching later can have that information. Please, distance is not a barrier. Wherever you are, we can come meet you. So that's where Vintage Accounting Solutions come in. But anyways, that is by the way. Now, enough of myself. Now let's I can undergraduate. Let's face you people now. Let's face you people now. Now let's go to the business of the day. So last week, we started with investment appraisal. Abi? So we started with investment appraisal, capital budgeting decision. Please, I made a very important announcement last week. I said that since I started this class about how many weeks ago? About 4, 5, 6, 7 weeks ago. If you have not been listening to me, if you have not, or if you are joining my class for the first time, if you have not been listening to me from the beginning of my class, please and please and please, this is the point where you listen. If you have not been, if you've been sleeping, you've been lying down while I teach. I know some of you lie down. If you've been lying down, please, this is the time where you sit up. Bond valuation might not come out. Portfolio theory might not come out. Investment appraisal will come out, although it didn't come out last night, which was very shocking to everybody. And that's the first time it's happening in years. Investment appraisal will come out. So it's different that this one is still gambling. This one is sure. So please listen to me. So last week I started with investment appraisal, where I told you what investment appraisal was. So please watch the video of that class on YouTube. That is the beginning or the base of the whole investment appraisal thing. But anyways, now last week recap, a little recap. I'm just going to do small. So started with investment appraisal, where I said that what do we mean by investment appraisal? I said investment appraisal is just basically you appraising your project. What I mean by you appraising your project, what it means is now you want to make an investment. You want to invest in a project. Maybe you want to buy a real estate. You want to invest in maybe pure water factory, plastic factory, whatever factory you want to invest in. Now, what I'm saying is, if they tell you that, or the person that is giving you the business is telling you that, okay, well, come, Mr. Isaiah, come and invest 3 million. I know. Come and invest 3 million in this particular industry. Then in the next, let's say if you start operation, if you start working, people that want to, that was how they convince us come and do MMM that year. They always have crazy marketing skills. They tell you that say if you work very, very well and your operations are very, very smooth, in the next 3-4 years, you're supposed to be making, you're investing 3 million, you're supposed to be making, say, 10 million naira. Mr. Isaiah, hey, that man will like money. You will first sit down. You will call family meeting first. Family meeting first. Say, come first. There's this investment. It makes sense that. They say, make I put 3 million. I will get 10 million in the next 4 years if I'm operating very, very well. You can't hear me. I'm sure everybody can hear me. I think it's from your end. Please, can you guys hear me?
Yes, we can hear you.
Thank you very much.
We can hear you.
We can hear you.
Just listen to me. So I'm saying that. So the man will just call family meeting and say, okay, let's make decide to come and invest 3 million, then get 10 million naira in the next 3 years. Sharp investment, good investment. But what I now told you that is what biochemists, microbiologists, all these medicine people, all these people that study mass comm, that is what they will go and do, sharp investment. But what I now told you as an accountant, a chartered accountant from that passed through ICANN, you cannot or you should not just assume those figures from your head. And don't just look at it that this makes sense, then go and put your money into it. What I'm saying is you need to discount that 10 million naira that you want to make in the next 4 years to today's value. Why are you discounting it? You are discounting it because you want to know the value of 10 million naira that you cannot see the future now. When you are not flash, you cannot go to the future. But you know the value of 10 million naira today. So what you can do is you can convert or you can bring the value of 10 million naira to the value of today. Now, let me give you an example. I use this instance where I said that there was a day after my physical lecture. If you guys can remember that story, where I went outside to buy Tim, you know that bottle Tim now. I took 500 naira to buy Tim. I was very exhausted. It was a very exhausting class. And I bought that bottle of Tim. And I gave the lady 500 naira. Then me, I was on my phone now. So I was just there chilling. I waited there almost 30 minutes. I did wait for change. I was just there waiting for change. So when it was about 20, 25 minutes, lady, how far now? Where is my change? Then she was like, oh, is this change I've been waiting for? That it is 500 naira. I mean, I don't even drink the Tim with half. I was like, when the Tim turned 500 naira? Tim that we used to buy 200 naira 2 years ago. Now, what I'm saying is, listen to me. What I'm not saying is, that 500 naira that I bought one Tim, listen, that 500 naira that I used to buy one Tim, as at 1 year or 2 years ago, that same 500 naira could have bought you about 2 or 3 Tims, yes or no? I'm sure my answer is yes. It could have bought you about 2 or 3 Tims. Now, what I'm saying is, the value of that 500 naira last year is not the same value of the 500 naira this year. The 500 naira is not changing, but what 500 naira can buy last year is not what 500 naira can buy this year. A lot of things could have happened. Inflation, according to what's happening in Nigeria now, market forces, a lot of things could have happened. Natural disasters, a lot of things could have cost the value of that money not being the same. But my point is that money obviously it should have reduced. Now, what I'm saying is somebody that told you to come and put 3 million naira, you collect 12 million naira in the next 5 years. What 12 million naira can buy in 5 years? What is the value now? So that is why we appraise projects, basically. That is basically why we appraise projects. So we want to see, okay, in the next 3 years, what is the value of this money? Should we make this investment? Should we not make this investment? That is basically where you guys come in as an accountant. That is basically, this thing you are saying is just 3 lines. But when you write the 3 lines, you cook it together. You will now come and hard English. It makes you look that's just the basis of being a professional. You now, okay, now let's say you've discounted somebody that 12 million, I want to discount it to this value. You know how to do it now. 12,000, you open bracket 1 plus R, they would have given you a discount factor that is the cost of the yield to maturity, the cost of investment. They would have given you to you. Now that's your R. So you say 1 plus, let's say 10%, 0.10, you reach to power maybe -5. You do -5. Abi, okay, somebody should do that for me now. Somebody should do that for me real quick. How much are we collecting in the next? We are collecting 10 million in the next 4 years now, or 5 years. So somebody should do 10 million, open bracket. I'm assuming 10%. 1 plus 0.10, close the bracket. This power minus, let's say -5. So that's say -5. Please, what's my answer?
6,209,213 naira 231.
6 million. Now, what I'm saying is, can you see that's the value of that thing in the next 5 years? 6 million. Don't forget you're investing how much? You're investing 3 million. Oh. Please, is it a good investment? Yeah, that million, is it a good investment?
Yes.
It's a good investment because it's positive.
No, because it's positive. No, because it's positive does not mean it's a good business.
Okay.
Now, what I'm saying now is, no, it does not mean now. You are investing 3 million in the next 5 years. The person is telling you that you collect 10 million. Now, it's 10 million you will collect though.
It does not make sense.
5 years.
Makes sense because of that value of the time.
Listen,
10 years.
but what you can buy with 10 million naira in the next 5 years is equivalent to what you can buy with 6 million naira today. So apparently, it's not as if you are making any profit. You are making profit, but it's just about 3 million. That's the profit. So for 5 years, I'm making 3 million. That's a mistake that all these MBBS students will be making now. It's not for us. So if you just get that, you see 6 million naira, you just write it on that. So you now cook English together based on the above calculation, comma, it can be derived that all things being equal, it can be assumed, you can cook the English together, it can be assumed that, or it can be concluded that this investment is not, okay, this investment, you can just even say this investment is profitable, because obviously there are profits there, it's profitable, but on the long run, it is not a good investment. You will not write reason. You will not say, because due to the time value of money, or due to some forces, you can say due to some forces, comma, e.g., time value of money, comma, inflation, comma, market forces, comma, the value of 10 million naira in the next 5 years is 6 million naira today. It is 6 million naira today. So automatically means that the profit on the investment is 3 million naira, which in your own, you see, all these things I'm saying, I'm already writing 6-7 lines just based on 2-3 lines calculation. That is basically what makes you a professional. If I sit down with that thing, I can write 2 pages. Yes, now, I have not written conclusion. I have not written recommendation. If I sit down with it, I will write 2 pages. And that calculation is just 1 or 2 lines. That is what we do in case study. That is why there is case study. That's why you guys are professionals. You are different from the rest. So please, that is where you come in and make some of these decisions. Accounting has passed debit and credit. It has passed debit and credit. It's not about more of strategic thinking. Anyways, that is basically what investment appraiser is talking about. Anyways, from there, so we now move to when we talk about the some of the methods of appraising investments. Where we spoke about the ones that help in profitability and some that helps in liquidity. And I told you that a business can be profitable and is not liquid. Where I explained that being profitable, it means that, okay, I gave you an example where I said that you can, in your store, you can have goods, you can have your inventory there, you can have 1 million inventory. Then this business is, it should be profitable now. Based on your inventory now, this thing should be moving fast. So it means that it should be profitable. But you are not liquid. Those things are not easily converted to money. Yes, they are not easily converted to money. So you are not liquid, but it's profitable. So I said that there are some that can be used to calculate profitability and some can be used to calculate liquidity. For profitability, we have NPV, which is your net present value. We have internal rate of return. We have modified internal rate of return. Then for the other one, and they're also called the discounted cash flow. The discounted cash flow, because it involves discounting factors. Everything we did involve discounting factors. Then the ones that are non-discounted, that's what is in your material. The ones that are non-discounted cash flows, they are the ones that measure liquidity, which is the what? The payback period, the accounting rate of return. The only one, you know, what's there again? Those are the ones I can remember. Anyways, if you guys remember, I can add it. So that is what those ones actually measure. So we started with MPV. We did MPV in class. We did IRR in class. We did modified internal rate of return also. Okay, people did MPV and you did IRR. But me, I did modified internal rate of return and I did payback period. Then I was supposed to explain accounting rate of return before moving to the main advanced investment appraisal today. Please, regarding all these things I spoke about, do I have any question? Please raise up your hand, please. Don't just raise up your hand if you have any question for me. There should not be any question, but let me just know if you're interested. If you have any question. Okay, so there is no hand up, so I assume there is no question. So it is clear. I saw you, the hands up. Oh, Miss Miriam, what do you want from me? Miss Miriam, I can hear you.
Good evening, sir.
Good evening, ma'am.
Sir, please, concerning the example you gave, I want to just understand something. You said if we discount the 10 million and it gave us 6 million.
Cannot hear you again.
So, hello?
Hmm.
Hello?
I'm with you.
Yeah, so you said if we discount the 10 million to today's value and it's giving us 6 million, I want to understand something. So does it mean that since you said that this 6 million is is good, but it's not a good business in the long run. So how do we know if the business is actually very good? Like if the investment is good, is it that when you discount the 10 million, the money you get is greater than the 10 million, or what? So I want to just know that.
I cannot hear you. You seem to be breaking up.
Hello.
It's mine. Miss Miriam, can you hear me?
Hello, sir. Yeah, I can hear you.
I think my network went for a while. Please, can you come again?
Okay, I was asking you that 10 million that we discounted to today's value, and it gave us 6 million. Can you hear me? So I want to ask, how do we know that this investment is actually very, very profitable? Is it that if the 10 million we discounted is higher than the 10 million?
How do we know that what? This is my network. I lost you at that point.
How do we know that 10 million we discounted now to today's value, the money we get to today's value is higher than the 10 million that they will give us in the next 5 years? Is it when we know that the business is very, very profitable, or the investment is a good investment?
That question is shaky. How do we know the 10 million naira they will give us? Now let me just explain that part to you. I'm sure maybe your question will be answered because I did not really get a good grasp of the question. But what that side simply means is, sorry, Miss Chima, please, can you help me with your video? Thank you. So what I'm saying is, at the end of the investment, no, not at the end of the investment, after you've done the discounting now, you now have 6 million naira. In the next 5 years, 10 million you will still collect too. You still collect 10 million naira. But the 10 million naira you will collect, what you can use it to do, the things you can use it to do is the value of 6 million naira as at today. So what it means is, when in the next 5 years, that 10 million naira, what you use it to do is the value of 6 million. What 6 million naira can do today is what that 10 million naira will be able to do in the next 5 years. So now what it simply now means is, the investment is profitable. You are going to collect extra profit of 3 million naira. But with the space of years, it's not a good one. 5 years is too long for you to make that kind of, for that kind of margin. So what it can, for the investment to be good, this investment is good, but for it to be better, let's say it's giving us like 8 or 9 million naira. You can say, okay, maybe it's still fair, a little. If it's not even higher than the amount than the 10 million, which I don't think is possible, because whenever you discount, the value is supposed to reduce. Whenever you discount a figure, it cannot increase, it has to reduce. So what I'm saying is, at least if it's not too far, if it's 10 million naira to 8 or 9 million, it's still better. And it would have been, if you know the number of years is too much for that. If it's about 1 or 2 years and you're making, I think it's fine. But for 5 years, I think it's a lot. So I don't know if that answers your question.
Yes, I did. Thank you.
You're welcome. Miss Esther, oh yeah. Anna Esther, please, your question.
Okay, good evening, sir. My question is,
evening,
you make mention of how to measure a company's, let's say, profitability level. You said by discounting factor, right? So I want to know, you made mention of the NPV. Or maybe I'm mistaken. I don't know. Maybe we can just go back and recap.
No, be me talk that one. You don't put a word from my mouth. What I said was, I said that some, like, how would I say it now so that you don't get confused? I said that there are some bases to measure investment appraisal that they deal with profitability. They are not used to measure profitability. Oh. They deal with profitability. That is, they are more profit inclined. The other ones are more liquid inclined. They are not used to measure profitability. They are just more profit inclined. This one is just more. They are more profit inclined as a reason why. I don't know if you guys notice. I'm sure you guys did not notice. But if you notice, when the ones that said they are profit inclined, when we're doing most of them, they involve cash flow, MPV, cash flow, IRR, cash flow, modified internal rate of return, cash flow. They all deal with cash flow. That's why they are more profit inclined. But the ones that are more liquid, they deal with accounting profit or loss. I'm sure people did not notice. They deal with accounting profit or accounting loss because of liquidity. So that is why it's not because of they are not used to measure anything. They just deal with it. They are just more inclined towards that way. I hope that answers your question.
Okay.
Thank you. Please, let's move on. I have a lot to do today. Anyway, so please, what are the assignments I gave? Somebody help me, please. Where did the assignment? I'll just tell you the answers. Oh, I hope you are correct. Anyways. Oh yeah, oh yeah, oh yeah, oh yeah, oh yeah, oh yeah. What are the assignments I gave?
Second is happiness. You also have to solve the one in question bank.
Okay, sorry. Let me just hold on, please. Let me share my screen and open the question bank so you guys just show me which one it is. I don't think I can remember. I also said I was going to tell you guys something. I heard a rumor. I'm sure it's a rumor anyways. So, but somebody had to tell me. Somebody said that I said that that you guys should not ask me questions based on topics I've taught. I don't remember ever saying anything like that. That should not ask me questions based on topics I've taught. But I'm sure I made a statement like that. But what I said was, your assignment, don't submit assignment of topics I've taught. Imagine somebody submitting bond valuation assignment to me now. I won't start from. Because I don't even know where the questions are. But once you don't ask me questions on topic, I will never say anything like that. I should not ask me questions. How now? Why am I now here? That I even used to accuse people of not asking me questions. It's only about 2 students. I can mention their names that used to disturb me with Pathfinder questions. Miss Miriam and one other person that used to disturb me with Pathfinder questions. People are not even asking me questions enough. So I don't think I just wanted to correct that. If there's anybody with any other opinion like that, I never said anything like that, please. Anyways, I'm looking for the material so that we can look for the question together. Okay, I think I've seen it. Let me share my screen. You guys will point out the question to me. Page what, please? I think nobody was telling me the page that time. I hope everyone can see my screen, please. Open no. It's just me. Please, I hope you can all see my screen now.
Yes, sir.
Okay. Okay. So the question was from it was from question bank, Abi. Should I leave it?
Yes, sir. Yes, question bank. Tinu N1. That's not the complaint. Tinu N1 Limited.
From the now.
Just choose. Page 35. I think.
There's a page on this now. Material says it's plenty.
No number, but
okay, this one.
Choose.
So what I asked you
Yes,
to
Tinu
do.
N1. Yes, Tinu N1.
I told you to do the MPV, the IRR, the payback period, Abi.
Yes. Leave out here.
Okay, then an answer that I was going to come and explain the accounting rate of return, Abi.
Yes, exactly.
Yeah, you also said we should add MIR to it.
Yes,
Okay.
MIR.
I don't forget. I had lots of MIR. I only solved for.
You did now.
Yeah, like me, I did not solve it in my own. Like because I did not check the assignment people submitted. I had to solve this question by myself so that I can come and give you people the answer and compare. But I just looked at the material. I did not know that I added MIR, but there's no MIR here. But I did not solve that one, so I don't know the answer. That's what I'm simply trying to say. But for MPV, for people that did MPV, if you had I might be wrong, but if you have may have about 13,009. Let me do this. I cannot even see my own handwriting. Sorry, there are 2 projects. For project A, I have 18,720. 18,720. Discount factor of 10%. Your first present value is negative. Your initial outlay is negative 200,000. If you use the cash flows are different, so you cannot use annuity. Abi, we have 120. Is it the same question I'm saying?
Yes, it's the same.
That's
Yes.
Okay. So the cash flows are 120, 60, 66. The scrap value is 14,000. The discount factor of year 1, 0.909, 0.826, 751. Last year, For the last year, the scrap value is still on year 3. So it will still be 0.751. So if you do the present value, you have 18,720. So if you have anything around that line, something around 18,000, you are correct. If you don't go get Canada, maybe you have USA, maybe you get UK, maybe you even can go get minus, just cancel it. You are wrong.
So
Cancel
please
it
come
like
again.
I should come
The
again with what?
The discount factor is 10%.
Yes, ma'am.
So we're having one. The year one is 0.909 times 120.
Yes, ma'am.
The year
So,
two is 0.
madam, I cannot be doing it year by year, but the shall like
I'm
that,
not
like
How
that.
did you get 18? Because I did not get 18.
What did you get?
I didn't get 18 as well.
What did you
8,000.
get? 8,000.
8,000.
Me too, I didn't get 18. No. 8,000 I got.
206.
Then it's 8,000. Maybe it's my
8,206.
calculator that gave me 18. Wow, they
Ah,
cannot even
beg
do
I
it.
thought I got
18,000.
18,720. Okay.
I
That's
think
what
it's
I got.
8,000.
I got 18,720.
Please, can everybody mute their mic? Just mute. 200,000 minus 109,080 minus 49. 560 minus 49, minus 49, 566, yes, minus 10, 514. Is 18,720 now. Why are you saying 8,000 from? I'm saying I got 18,000 here. I did it again just now. No, I got 18,000. I don't know.
So
We should
I'm
try it again.
thinking the 8,000 they got, maybe they did not include the scrap value.
Maybe that's why.
Oh, are we supposed to include the scrap value?
Yeah. Please include the scrap value. It's year 3 now.
Yeah, 366,000 now times 0.75.
Yes, year 3 is 66,000. But now, why scrap value is part of the things that makes up the cash flow. Now, what scrap value means is this is the amount you later sold this thing for. Won't you include it in your cash flow? Abba now. The money that came in now. So what this thing is telling you is okay, you made an investment, you invested 200,000. Year 1, you collected 120, year 2, you collected 60, year 3, you collected 66. Now, year 3, you sold it for 14,000. So the amount that you sold, you threw it away. It's not part of your cash flow. Okay. Say now, year 3, 66,000. Please add your scrap value, please. Thank you very much. It's part of the money now. You sold it for something. So it's a cash inflow to you. Scrap value. Don't scrap. You sold it. So it's part of cash inflow. So please add it to it. Eshe. So for the first one, 18,720. For project B, 13,936. So I'm sure people have like 3,000. People have like 3,000 like that. Please add that.
Project B, I have 4,009.
At 3,000, at 4,000. What's the difference? I don't know why I'm laughing anyways, but it's very funny. So please add the last scrap value to it. So that's what you should have got. So
just add the scrap value. Are we discounting the scrap value or we just add it?
You discount it now. You discount year 3. You use year 3 because you sold it at the end of year 3. So you use year 3 for it also. So
okay.
Loba. For IRR, I don't know about you, but for my own IRR, what did I assume, Seth? I did one mago for my IRR, so I'm sure that our IRR will not even be the same thing. I use the same discount factor. But I'm sure it will not be the same. So I will not really dwell on IRR because okay, let's do it like this. I use 15 and 20. I don't know what people use, but I use 15 and 20. You know, our IRR cannot be the same anyways. I use 15 and 20 to get my positive and to get my negative NPV. And I had 16 and 17. For project A, I had 16. For project B, I had 17. Don't worry, it will not be the same answer. IRR cannot be the same for everybody because we use different discount factor. So I'm sure that one will not be the same. But for the IRR too, for people that know at scrap value, you people are wrong already. People that know at scrap value, you people are wrong already. Because you're supposed to add scrap value for the what is waiting bizarre. That's So please, for people that know how scrap value, people are wrong. So at the last year, you had your scrap value. So you have 16 and you have 17. If you don't have 16 and 17, you added scrap value. You are still correct. It's just because we chose different discount factor. That's the reason. For your payback period, you should have. What do you have for your payback period for project A?
2.3 years.
2.3 years. Project B?
2.4.
2.4 years. Is there anybody that got Canada?
I got that one. No, only that
2.36.
To 2.36, and it's still the same thing. Did anybody get Switzerland? Or do you get minus? Let's know now so we can help you. Anyways, so that is that for that. Please, is there anybody that did not get anyone out of everything we've been saying? Raise up your hand now. Let's know where we will start from. Most people did not attempt it, which is fine. If you do not attempt it, it's fine. You're on your own. But if you attempted it and you did not get what we've been mentioning, please let's see so that we can know where to come in. Miss Esther, please.
Okay. So for the MPV project A, we have a cash, an outlay of 200,000.
Yes,
then
ma'am.
giving me present value of 200,000. Yes, and then for year one, we're having 58,000 as a cash inflow, and then I discounted is using 10%.
We have written
In total, 58,000 for the cash inflow, right? 58,000, and then I discounted using 10%, and then the total for project A, I'm getting a negative balance of 135,000. I don't know. Maybe I get everything wrong. I don't know.
Hold on.
Even same thing for project B. I'm getting a negative balance, and then I don't know. Maybe I did mistakes somewhere. I don't
know. So now what you did was you used, what would I say now? So you used the 58 like that. Abi?
Yeah. Yes.
Well done. Did anybody also make that mistake also? Let me know now.
Yes,
did anybody use use the 58 like that? You cannot now. Let me explain something to you guys. Or let me tell you a trick. Even though I used to give you tricks. Whenever you see that in you want to determine NPV, listen to me, you will not listen now. Whenever you're supposed to determine NPV and they are giving you profit, they are giving you profit or loss, know that is a trap. Are you listening? If you should put it in your left hand and don't use it to eat, or you put it in your right hand if you are using left. If they give you profit or loss, know that it is a trap. It is a trap because I just even mentioned it now. Whenever you want to do NPV or RRR, you don't use accounting profit. You use cash flow. For accounting profit, they have added depreciation. You don't need depreciation for you to get cash flow. What cash flow means is depreciation does not involve cash flow. Now, does depreciation involve cash flow? No. So for NPV, IRR, you don't need cash flow. You don't need profit. You just need cash flow. But whenever they give you profit or loss, they have added depreciation to it. So the next thing you go and do is you will need to subtract, not subtract now. You need to account for the depreciation. So what they've done is they've gotten a loss for, they've gotten a profit for you. And once they've gotten a profit, what it means is, even if you are doing your profit or loss now, you will do sales, you will do your cost of goods sold, you now do expenses. Depreciation is part of it. You would have subtracted it to get your profit, Abi. That's what they have done. So for you to now get back that cash flow, you now go and add depreciation. You first calculate depreciation. You now go and add depreciation back. That will give you your cash flow. So for people that were getting that answer, what they've done is, they gave us cost. We have residual value. So they've subtracted their cost from their residual value. They've divided it by the number of years to get depreciation for each year. Okay, it's even going to be one depreciation, says it's just one. So I think the depreciation is going to be one value. So once you get that depreciation, you're not going to add it back to all the cash flows. That's why we had 120, 60, and 66. Are you confused? Is anybody confused? Please speak up now. Let me know what I'm doing.
Yes, I'm still
I don't.
confused.
I'm still confused. I'm confused, sir.
We are good.
I'm very confused now. We are confused.
Yeah.
Not that clear.
Otidoju means that we have gotten to the eyes. Hey. Okay. Let me explain like this. Listen to me. Just calm down. It's not hard. It's mentality. Just calm down. Relax your head. Sit down very well. Rest on the chair. Carry your Bible. Now listen to me. I just mentioned something not long ago. I said that if you want to do, there are some cash flows that are discounted. There are some that are not discounted. The ones that are discounted, they measure profitability, which are the MPV, the MIRR, the IRR, the three of them, and there's one other one. Anyways, what I'm trying to say is that you see these particular ones I've listed, they don't deal with accounting. They don't deal with accounting profit or loss. It is the payback period that deals with accounting profit. These three I mentioned, they deal with cash flow. They do with cash flow. Cash flow in respect of either cash inflow or cash outflow. They deal with either cash inflow or cash outflow. Cash inflow can come from means of maybe sales. That's where cash inflow can come in. Cash outflow can come from maybe initial outlay, all of those plenty things. Now, what I'm now saying is, from your cash inflow that you've calculated now, you can, if you guys remember the format of profit or loss, I'm sure you remember. Sales, Abi. After sales, all those other you shall get your what? You get your cost of goods sold, Abi. After cost of goods sold, you will now get what? You will now come and go and less all your expenses. Part of the expenses usually less is what? Depreciation. Abi. After you remove depreciation, what do you have? Accounting profit. Abi. Good. Now you already have your accounting profit. So what you are simply doing a walk back. So now, okay, let me put it into paper. Maybe you will understand. Maybe it's because I'm shouting with my mouth. Now what I'm saying is, look at my screen now. Now what I'm saying is, what we've done is you've done cash inflows, which came in the format of sales. Abi, this is what you've done. You've now added expenses. Let's assume depreciation is even the only expense that is there. Depreciation. Depreciation. I do not plan to take long like this on this one. Is equals to what? Our accounting profit or loss. Abi, please do a walk back and remove. Do a walk back and remove. What's the name? Do a walk back now and make this. Do a walk back and make this cash inflow. Make it what's the name now? Make it the subject of formula. What do I have? No, sorry, this is minus. Sorry. You subtract your expenses now. Subtract expenses now.
Yes.
So what do I have?
Accounting
so
profit.
You have cash inflow.
Accounting profit plus depreciation.
You have cash inflow equals to what? Accounting profit plus depreciation. So this is simply what we are doing now, because we don't need accounting profit for any. We need just cash flow. That's why I told you. Whenever you want to calculate, and please listen to me. I don't think this simple question will come out in your exam, but nobody can say. What I'm saying is, if they ask you to calculate MPV, IRR, and you are given accounting profit, please, it's a setup. It is a trap. Don't fall there. There is no question in this earth. Listen to me. I'm challenging you. There is no question in this earth that they will ask you to calculate. They will ask you to calculate MPV or IRR. They will now give you accounting profit. listen, that they will not give when they not give you account, there is no information to account for depreciation. There is no question like that. If they give you accounting profit, there will be information that will account for depreciation. Either they give you just the cost, or they give you only cost, no residual value, like initial outlay. So what if there's no residual value? Just take that cost divided by the number of years, it's still depreciation. If there's residual value, subtract residual value divided by number of years, it's still depreciation. But what I'm saying, there's no question that they will give you accounting profit and they will not give you any information to account for depreciation, because they know that you don't need the accounting profit for anything. NPV, IRR, they use cash flow, no accounting profit. So this is what you have done. Cash flow, you now do accounting profit, add your depreciation. So for this question now, you're supposed to do 200,000 divided by 200,000 minus 14,000, that's 6,000. 6,000 divided by now, what's the number of years? I think that's about 3 years now. I cannot particularly. Is it 3 years?
3 years. 3
Divided by
years.
3 years. So I think you have like 62,000 for each year. So now add 62,000 to 52,000, you have 120. 62,000 add it to minus 2,000, you have 60,000. 62,000 add it to add it to 4,000, you have 66,000. Then that is now the cash flow.
Okay.
Anyone that does not understand like this, what you learn here.
Okay,
So
sir.
I've used all the energy in me.
Thank you, sir.
I hope it's clear now.
Very clear.
Yeah. Yes.
Thank you very much. So it's still the same thing for the other way around. If there are some that you need to use for the other one, the remaining payback period, and the ones that you need to use accounting profit, and they give you cash flow, what do you do now? You will now go and do what? You will now go and subtract depreciation from it. It's that simple. If there's anyone that you need accounting profit, I think payback period, you need accounting profit. Anyone that you need accounting profit, but they are giving you cash flow, that one too is also a trap. Account for your depreciation, then subtract it. You not add it now, you not subtract it from it to get your accounting profit. Just look at this thing and be very careful. It's just subject to formula. What I'm saying is, if there's anyone that you need accounting profit for, see it yourself. Anyone that you are supposed to use accounting profit, just do your cash flow, subtract your expenses, then you will get this one. Is that easy? Oh, that's fine. Anyway, so let me explain accounting rate of return in the next 5 minutes. Then I'll move on to what I have to do today. So yeah, please, you people should come and answer for me again. Let me write them here. Please, if you need this, you can write it down so that you can. Or let me leave it here so that people can see it in your material. So let me see solution to assignment. I'm not doing it though. I don't have that time. Solution to assignment so that people can know the answer. So somebody that did it and got it correctly should call the solution for me. It's not those people that know how to scrap value, or those that did not have scrap value. They should move one side. People that did the assignment very well and did it correctly, please call my figures for me.
The net present value for project A is 18,720.
PLC. So I'm saying project MPV. So let's say MPV. So I assured you people, you went to do. Now wow, I'm not happy. The way you used to disturb me.
Sorry.
So project A.
18,720.
My project A.
18,720. Positive.
People are not answering me again. No.
Project B, 13,936.
Project Bingo.
13,936.
We are.
13,936.
See, I've done my corrections now.
So IRR for project A is what?
IRR, I actually used 10 and 18%. So for the project A, I got 15.93. That's, let's just say 16%.
So for project A, you use 13%, Abby?
I used 10% and 18%.
So you had
15.93. Then for project B, the same thing, 17.02.
Okay, use 10% and 18% also.
Yes, the same for the both.
So that's what?
17.02%.
17.02.
Then the payback period.
Sorry, please let me add disclaimer to this thing because I know my students very well. So they go say, somebody will be calling me early in the morning and telling me that's not what they got.
It's never reach like that now.
Oh, she busy people. Please note that the answers in
Is this case
above,
study?
leave it like that. Know that the answers in above was gotten using the above discount factors.
Okay.
Your own discount factors might be different, giving rise to a different answer. I'm supposed to write that. Please, on no occasion should you call me that you got a different thing, but I will not write it. So yeah, payback period.
Yeah. Our payback period for project A, 2.3 years.
Project A
2.3 years.
2.3
Yes.
years.
Then project B, which I got 2.36, but is approximately 2.4.
Equals to 2.4 years.
Yes. Then I also did that MIRR, but I don't know, since you said you didn't do that, so maybe we just.
What did you get for MIRR?
Okay, for project A, I got 11.43%.
Is that what you got? People that did scrap value.
Yes, it's correct.
Yes, correct.
I have 11.48, so but I didn't do scrap value, sir. Thank you.
So why are you calling your answer for us when you know deep down that you are wrong? So I'm listening to you. Project A.
Okay, project A 11.43.
11.43%.
Then project. Okay, I got the same thing for project B also.
Project B.
Also 11.43.
Let me now put another final disclaimer. Disclaimer.
It's okay now.
The above.
What is your cash inflow and your cash outflow?
The above answers were gotten collectively by the class. Please solve by yourself for confirmation. Eshu, thank you very much. Oh yeah, this is the one that I'm doing by myself now. Pay accounting rate of return.
So I did that one.
If you get this one, I will forgive you for the rest.
Okay.
So what's my formula for my
ARR, estimated average annual profit over estimated average investment, 100/1.
Estimated
Average annual profit.
Estimated average annual profit
Over estimated average investment, 100/1.
Average investment. So can you guys see that this one is even very, very obvious? They have told you that annual profit. It is profit, not cash flow. They are different. Profit is different from cash flow. Cash flow is just the money that either going out or coming in. For profit, they've removed all the expenses needed. It's usually depreciation that we account for, because depreciation is not movement of cash. So it does not that account. You know that accounting profit is different from tax profit. You know now. So tax profit is not they would have subtracted or they would have added back the things that they are not supposed to have been subtracted. But accounting profit, you would have subtracted those things already ahead. So please watch out. So for this particular one now, so for that question, for this particular question now, where do we start from now? So let's first of all let's determine 1 minute.
Average investment.
So for the first one, let's determine our average. Let's determine our average investment for the first part of the question. Let's determine our average investment.
Our average investment, initial outlay plus residual value over 2.
I'm coming now. So you said initial outlay, well,
plus residual value over
so let's
2.
say let's determine our average investment first. So you're saying average investment, which is equals to
initial outlay.
We are saying initial outlay minus residual value.
No, plus residual value.
Plus residual value over 2,
Over 2, yes. So the other one is times 100 over 1, no?
I know.
Okay.
Please, this 2 is constant, though. It's not because it's not number of years, so it's just it's average. Average is divided by 2. It's very constant. It's not by a number of years. Oh yeah. So what's my too long. Just note this down. So what's my initial outlay?
200,000. Project A.
100,000
plus 14,000
plus 14,000
over 2.
14,000 over 2. Please, what's my answer?
107,000.
107 what?
107,000.
107. 107,000. That's the first step. Now let's go to the other one. The average annual profit. This is where there is work. So you now say average. What's the formula for average annual profit?
The estimated average annual profit. So you're going to add all the profits.
I will do it.
Estimated average annual profit.
So what do you say I will not do now?
You add all the profit for the 3 years.
And divide by 3.
No, you're not dividing it.
Regular average.
Why is average? Sometimes they might give us like this one now, they just give us like this project A. They did not give us like, they might give you like 2 profits. I don't know how to explain it, so I explain it.
I don't even know what you're saying. She actually explain it. I'm not supposed to explain what I don't know what you're saying.
Oh God, I cannot teach.
Can you rest you? Please control you.
I hope I got this thing. If not, I'll be very sad. What are you doing?
So now what am I doing? Please, my number of years. There are how many years there?
3 years.
So year one, good of mercy. Year one, year two, year three. What's my profit?
58,000. Year one, 58,000.
Minus
Year two,
2,000.
Minus 2,000.
Year three,
4,000.
4,000.
So now let's do something. So let's calculate. Let me first do that here. Okay. So let's say determination of depreciation. So your depreciation, so you say depreciation is equals to what? What's my formula for depreciation?
Minus
Cost.
residual value all
Cost
over.
minus. Okay.
Cost minus residual value
My number of years.
over number of years. So you now see depreciation. Please don't go yet. I've not even done what I want to do today. People that like to run away before class ends. Please, the most important part, I've not even done it. So what's my cost?
200,000.
200. What's my residual value?
14,000.
14,000.
Okay, it's even that same thing we got that time now. Number of years, 3 years.
Yes.
Yeah.
What do I have? 60 what?
62.
62,000. So if
I
you
didn't
come
know
here,
about this one now.
do 62,000. 62,000. What do you have first? What was your answer?
Me? 56%.
56.
Yeah. Project
And first fear God.
I have 18.69.
Please, what's my this thing? I beg, leave this woman alone. 18
Yeah,
point.
I did not. But they said
56
that
point
they
as
said
how?
profit now. I didn't know that we're going to remove depreciation.
Okay, please, coffee go for me, please.
Oh God. Figure.
Figure.
For the first year is 120,000.
120,000 as how now, as how? What did you do?
Negative 4,000.
Madam, you cannot have now. This one is profit before depreciation. Profit after depreciation. You subtract now.
Minus 4,000.
4,000.
Yes.
Minus 60,000. Oh, minus 64,000.
64,000 minus.
Minus what?
64,000, not 50. 64,000, not 60,000.
64,000.
Grandma, you hear me? This last one is what?
That year 2 is 64,000 negative.
Year 2 is 64 minus.
2,000 minus and minus plus. Why is that? Why is it now still negative?
Sorry, the 4,000 is a positive.
64,000 positive.
This one is positive now. You do minus 2,000 minus. That's minus times minus now. That's 2,000 plus 62,000. That's 64K. This one go.
66.
Sorry, the 4,000 is positive. Year 3.
66,000.
Like this. Like this, I mean.
It's 58,000. 58,000.
What's happening
The
now?
4,000 is not jacketed. The 4,000 is not jacketed.
If 4,000 is not jacketed.
Yeah, correct. 66,000.
If I get wrong answer, is you people.
Profit
Please, sir, what are we doing,
before
sir?
depreciation.
What
Year
you are doing
3.
is you are subtracting this from this now. So what you are doing is 58,000 minus 62,000 minus 2,000 minus 62,000 minus 4,000 minus 62,000.
It's not
Minus
4,000.
4,000.
It's not
4,000. It's not flat.
Are you saying the
It doesn't have
4,000 is
minus.
positive?
Yes, it is for positive.
How?
Oh, let me go and look for calculator. Let me do it by myself.
No,
It's
let
minus
us start
4,000.
from the question. From the question.
Taba, if you cannot do simple, please, can we all keep
It's
muted,
minus
please? I don't understand
4,000.
calculator. Please, can we keep muted? Thank you. Becomes 4,000. This one becomes this here minus 4,000. Man, no see calculator. Can you give me correct answer, I beg?
It will be negative, sir.
Is it minus 4,000? Just 4,000.
It's minus 4,000 minus 62,000.
Sir.
This thing is positive now. Why you? Why
The
you? It's
4,000
minus
is
4,000
not
minus
minus.
62,000.
Are we not
4,000 is not minus.
minus? It's minus
That
minus.
4,000 is
The
positive.
4,000
The last 4,000 is
is
positive.
positive.
So it's like this, I mean.
Yes.
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 So we should have
So it's
58.
minus 50 now.
So
Minus
so this
58
Minus
one.
58.
So this gets soon gone.
is correct.
So you have minus 58. Like this.
Yes, sir.
Please,
That
it's
was my.
minus 64,000.
I don't come on. People said it's correct now.
Yes, that's correct. Minus
It's
64,000.
minus 64,000.
It's
Yes.
plus,
Why
it's
would it be
positive
minus?
now. Negative plus negative.
The 2,000 is minus in front now. Then
And the
minus
other one is
62.
minus
Do minus
62,000.
2,000 minus 62,000 now. Are you
It
with
will give you
calculator?
minus
Minus
64,000. Use your
64,000.
calculator. Don't do assumptions,
Okay,
please.
please.
Minus 2,000 minus 62 is
One class,
minus.
one class.
It's
Hold on,
minus
hold on, hold on,
64.
hold on. Please, let me first check something first. Okay. Please, if you are streaming on YouTube, you can try to join the class. The number is reduced. Anyways, 1 minute. Doing something.
Sir, please, I have a question.
If it's about this, don't ask me. It's about this accounting rate of return. Please don't ask me. If there's another one, you can ask me later. So now, please hold on with whatever question. Now, what I'm supposed to do is I'm supposed to determine my profit after depreciation, yeah? So with whatever profit I get, I'm supposed to bring it to this. That particular profit now, is an average, what's the name? It's average annual profit. So you're supposed to sum all these profits together, like for year 1, year 2, year 3. You're supposed to sum up everything together, then divide it by what? So you now divide everything by 3 years. That's what you're supposed to do normally. So whatever profits you get, all of them, you divide it by 3 years. So once you divide it by 3 years, then you move on with your. So you get a figure. So once you get a figure, you're not gonna put it in this formula, and you get your answer. That's what I'm supposed to do. But we cannot give me what I need. I've decided to. I will skip the question when people are ready to give me my figure. I will come back to it. Please,
Sir,
let me go to
don't
what
give it, sir.
So I'm ready to give you your
That year 2 is minus 64,000. The minus is at the back of this 2,000 naira. Minus then at the middle, minus. So make it negative.
Okay, advanced net present value. At the end of the class, if there's time, I'll go back to it. If there's no time, I'll leave it.
Yeah, I'll let you forward.
Oh, please, are we still together? Please just give me, what would I say? Please, if your question is about accounting rate of return, you can hold on to it or leave it. If there's still time at the end of the class, I can decide. But I've not done what I have to do. This is almost 11. I've not done anything. I don't think I can be wasting my time on that. There's not going to come out. But anyways, if there's still time at the end of the class, I'll go back to it. If there's no time, I'm leaving it. Please, can you give me, what's the name now? Can you give me a reaction if you are still here? Just send maybe any emoji you like. Thank you very much. Now, let me go to what I want to do today, please. Thank you very much. Let me start like this. So let me first give you guys a general breakdown of what we are trying to do. Now, people have done basic net present value. Please listen to me. Oh. If you are streaming on YouTube, you can join the class. The class is a little free. Please listen to me. What I'm saying is, now, what was I saying? Okay, now let's go to the advanced net present value. Now, when I mean advanced net present value, now this is where we now deal with a lot of cash flows. We deal with a lot of years. We deal with relevant cash flows now. You know, this one, they just give you cash flow, then you're just imputing. This one now, we deal with relevant cash flows. We deal with taxation. We deal with inflation. We deal with working capital. We deal with a lot of things for this particular part. So this is where work is. All those ones that we've been doing is child's play. There's no work there. This is where work is. That's why I told you guys, okay, before some people will start feeling, let's work tomorrow. Let me go to the one that is very, very important. All those accounting rate of return cannot come out. So let me go to the one that there is work. So now, listen to me. Now, let me first start with, whenever you want to do anything called advanced net present value, that's not the name. I'm sure some people might be looking for advanced. That's not the name in your material. It's just me that's calling it advanced net present value because it's different from the one we've been doing. Now, we will consider 4 things. Listen to me. If you can jot. You know, I'll first explain. So we'll consider 4 things majorly. First of all, we'll consider what we call relevant cash flows. Listen, we'll consider what we call relevant cash flows. Secondly, we'll consider what we call taxation. Thirdly, we'll consider what we call inflation. And then lastly, we'll consider what we call working capital. I will explain each and every one of them. If time permits us, I will solve a simple example. There's no simple example with investment appraisal anyways. But I said we'll consider relevant cash flow, we'll consider taxation, we'll consider inflation, then we'll consider what working capital. Now, let me break them down one by one. Now, for what's the name now? The first one, relevant cash flows. Now, please, if you are streaming on YouTube, try to join the class so you can hear me clearly. Whenever your cash flows, they will pack all the cash flows there, either the ones that are relevant and the ones that are not relevant. They will just pack everything there. It's now left for you to know the one that is relevant and the one that is not relevant. I said it's not left for you to know the one that is relevant and the one that is not relevant. How do you know the one that is relevant? I call some tests. I call them, let me list them here. So I said the first one, you need to consider what? Relevant
cash flows.
Relevant cash flows. So you consider what again? Consider inflation.
Taxation.
You consider taxation. And lastly, you consider working capital. Working capital. So now let me start with relevant cash flows. I'm putting all these things in your material intentionally so that you can see it when we are done, so that you don't forget. So now, relevant cash flows now. For you to say a cash flow is relevant or a cash flow is not relevant, for me, I used to say you should allow them pass through a few tests. I call them MDF. That's the name I call them. I call them MDF. Like allow them to pass through these 3 tests. For M is called movement of cash. Now, for you to say a cash flow is relevant, make sure that the cash flows make sure that there is movement of cash involved. What I'm saying is, they're saying, okay, like cash is being exchanged. Okay, sales, obviously, anybody that is buying is giving you cash. Expenses, whatever thing you are doing is cash. There are some that does not involve movement of cash. Example is depreciation. Depreciation is not, there's not as if when you say, okay, your asset has depreciated by 4 years, is anybody paying that 4 years? Is anybody collecting money for that 4 years? When you say you amortize, amortization does not involve anybody's not collecting, nobody's accepting, nobody's receiving. So it does not involve movement of cash. So there's no movement of cash. There's no movement of cash regarding depreciation or amortization. So make sure that whatever test you want to do, make sure that it involves movement of cash. You get, make sure that there is movement of cash. Now, the last one, let me start with the last one, futuristic. Now, when I say futuristic now, just whatever cash flow you want to consider relevant, whatever cash flow you want to consider relevant, make sure that it is futuristic in nature. Make sure that it is futuristic in nature. When I mean futuristic in the sense that, okay, they say that, okay, this cash would be spent in the next 2 years, or this cash would be spent in the next, say, 3 years or 4 years. That is futuristic. I'm always calling me like this. That's futuristic in nature. Please, you guys give me 1 minute. 1 minute. Yeah, very sorry for that. Very, very sorry for that. I had to attend. That number has been disturbing me since morning. Anyways, so I said that for F now, it means that if it just allow cost, I mean a cost that is futuristic in nature. So when it's futuristic, it means that they are telling you that, okay, this one is in next 2 years, in next 3 years, 4 years. That's futuristic in nature. The first one is that it involves movement of cash. The D in the middle, it stands for it's for differential. When I mean differential, that is how would I explain it now? Let me say opportunity cost. If you guys know what opportunity cost is the alternative forgone. So what it means is, let me give you a very example of what I use for opportunity cost. Now you have 1,000 naira. You have 1,000 naira. You want to go to the market. Are you listening? You have 1,000. You want to go to the market. In your mind, you feel like you will buy 1 cup of rice 500, 1 cup of beans 500. That's the 1,000 that you want to spend. Are you listening? That's the 1,000 that you want to spend. 500 for rice, 500 for beans. On getting to the market, only rice alone is 1,000 for 1 cup. Beans is still 500, though, but only 1 cup of rice is 1,000. But you have only 1,000 naira. So in your mind, you feel like, okay, I can just buy rice. Rice will still swear. For people that live like me, bachelor life, you feel like rice will still swear, beans will not swear. Hunger will enjoy you. Say, okay, let me go just buy only rice. Let me leave beans. Since it's only 1,000, I can buy rice. The opportunity cost in that situation is the 500 naira that is going. That is the only one you will record. 500 naira. Because that is the cost of the alternative forgone. You have forgone the 500 naira for the beans. So that is the cost for the alternative forgone, 500 naira. So it involves in a differential cost. Differential cost, if you don't select this one, you will select this one. Are you listening? If you don't select this one, you will select this one. So that 500 naira is the opportunity cost. That's the differential cost. That being settled. So those are the costs that are relevant. Movement of cash. Does it involve movement of cash? It is relevant. If it does not involve movement of cash, it is not relevant. Is it differential? Differential, that is, does it relate? Is there an opportunity cost? Am I choosing one thing instead of another? They don't necessarily have to be. Am I choosing one instead of another? Am I letting one go? It involves differential cost. And that one does it involve futuristic cost? When I say futuristic in the sense that is in 1 year, 2 years, 3 years, that's futuristic in nature. Another one, incremental cash flows are also very relevant. Let me add it now. Incremental cash flows. When they say incremental, that is, they tell you that, okay, as at today, this is the cost. But in the next 2 years, or it is going to increase by a certain percentage. That is also what? That is also very, very relevant. Now, let me now go to the non-relevant cash flows. Now I told you I can do, they will pack everything together. The non-relevant cash flow, the one that they use the most, the two that they use the most regularly is interest and sunk costs. Now, interest in the line that, you know that if part of the capital or part of the money or part of the initial outlay, if it has an interest, let's say part of the initial outlay has debt factor in it, please listen to me. Part of the initial outlay has debt in it. You'll be paying interest on that debt. Let's say 10% interest, that's 1,000. Let's say you're paying 1,000 interest on it. Now, what I'm telling you, take it from me, that 1,000 is not relevant. It is very irrelevant to this particular project. You know, I've told you before that we have two different minds when it comes to SFM. We have church mind and we have devil mind or evil mind and church mind. You see that your evil mind is telling you that but debt is part of the capital that was involved in. How will you not tell me that the interest is not relevant to that business? You have to subtract the interest now. Abi, it's not part of the business. The stuff was the capital, the debt was used for the business. So the interest is supposed to be relevant. That's your evil mind telling you that one. No. That evil mind, leave it at home first. Evil mind, leave that. Now let's now take our church mind. Me, I'm not telling you that yes, that 1,000 naira or that 10% could have been relevant, but it is not relevant because when we were calculating our cost of capital, you guys have done cost of capital now. Let's say we use WACC. When we were calculating our cost of debt in that WACC, we would have used that interest now. Have you forgotten? When we do bond valuation, if you remember, when we do bond valuation for cost of debt, we would have used that interest to calculate WACC. So you have taken account for it. So if you have taken account for it in the cost of capital, it does not make sense. That's just double counting. It does not make sense to now come and take account of it again. You have used that interest in calculating your WACC. That's the end of it. Don't now come and bring it and come and use it again. You are treating it twice, which is wrong. So that is why interest is not relevant. That is what your church mind should be telling you. Interest is not relevant. Leave that evil mind, leave it at home. So your church mind is not relevant. So interest is not relevant. Another one that is not relevant is your sunk cost. So sunk cost or past cost or research and development costs, they are not relevant. They are not relevant because, see, these are the things some of the lecturers will not tell you. I've been to classes where some lecturers will just come, they will write it, they will list the relevant ones and the ones that are not relevant. They will not explain to you why they are relevant and why they are not relevant. So some of you, you'll be doing guesswork. I was a victim. You'll just be doing guesswork. This one should be relevant. This one should not be relevant. You just be guessing. I was a victim. So that's why I decided, okay, if you know what the basis is, you will be able to confidently select the ones that you feel like are relevant and you feel like the ones that are not relevant. Now I've explained to you why interest. So now for some cost or past cost, so any cost that you see that maybe they spent or it was incurred before the project started. Listen to me. It was incurred before the project started. Is a sunk cost. They are like past cost. Let me give you an example, or let me tell you why sunk cost is not relevant. For people that stay in Lagos or Ibadan, if you want to go, Lagos is even very terrible. Do you know how many what they used to call this thing? Inspection fee that you have paid agents. It cannot count. The amount of inspection fee that you have paid agents. Now, what I'm telling you is, does it mean that if you pay inspection fee, you will collect the house? No, now. Lagos agents, they are one of the richest. I'm not even lying. Yes, now. They can collect 20 inspection fee in a day, and none of them will collect the house. If you collect 4,000, 5,000 from 20 people, do you know how much that is? Cash out in a day. So what I'm saying is, now let me now use myself as an example. I want to start a project. Maybe I want to build an ICAM center, but I'm looking for land. I'm looking for a place to rent, and I'll pay agents and I'll pay inspection fee to go and check the place. Then I check the place that I don't like it. That 2,000 naira that I spend, if I now later get a place in another location, that 2,000 that I spend for that agent, will I now go and add it to that next one? No, now. That one is research and development. It's also called sunk cost. They are costs that you spent before you begin the project. You will not add it to it. It is not irrelevant cost. So when you see costs that they say, during the process, although some research and development can be relevant. Listen, you see something about investment appraisal, there are tricks to it. If you know all the tricks, you are fine. Some research and development cost can be relevant. And they can be relevant in the case where they said it is incremental. These are places where they trick students. I've told you now that research and development cost is not relevant. Good. But in some cases, they will tell you that it is incremental. It increases by a certain percent. Please, it is relevant in that place. But if it is not incremental, but if it is not incremental, then it is not what? Then it is not relevant. Please, is there any question regarding that? No, there should not be question. I feel like I explained that very well. Even me, I understand it the way I explained it. I've not seen down. I'm sure there's no question. But please, if you have question, just hold it first. Let me finish the explanation so that you can ask them together. So that is for cash flows. That's for relevant and non-relevant cash flows. Now, what's the next? The next is inflation, Abi. Now let me explain inflation. So for inflation now, we have. Okay, first let me even say what is inflation, or how do I can actually just take inflation. Inflation simply is telling you that maybe how would I explain it now? Say maybe this thing has increased by 5% or has increased by 6% or 7%. That's inflation generally. Now, what I'm now telling you now is that first of all, we have two types of inflation. First of all, please listen to me. I hope somebody's listening. We have two types of inflation. We have one that is called general inflation. We have general inflation and we have specific inflation. We have general inflation and we have specific inflation. When I say general inflation, what general inflation simply means is, okay, let me start from specific. What specific inflation simply means is, now let's say they've given you a lot of cash flows. They've given you sales as a cash flow. They've given you variable cost. They've given you fixed cost. Then what specific, so they can now tell you that, okay, sales has increased by 5%. But variable cost is increasing by 8. That is specific inflation. It is specific on the cash flow. Either inflow or outflow, but it's specific on the cash flow. Okay, sales increased by 5%. Variable cost increased by 7%. Fixed cost increased by 8%. It is specific on that particular cash flow. But when they say something is a general inflation, what general inflation simply means is they have listed all those cash flows, sales, variable cost or fixed cost. So they now say all of them increase by 5%. Do you understand? It's not specific. It's not on sales. It's not on variable cost. Everything increased by 5%. That is the general inflation. Please, general inflation is different from specific inflation. Specific is specific on the particular line item, on the particular cash flow. But general is for all of them. Now, I'm still on inflation. Let me now come down a little. Now, there's something we call real cash flow and what we call money cash flow. Listen, everything is in your material. Everything I'm saying is in your material. I'm just explaining to you so that you can understand what I'm saying. I think everything is in your material. Let me confirm. I'm sure everything is there. So let me still confirm that I'm sure that I'm talking to. Okay, everything is there now. See it here. I finished work now. See it here. I finished work in this material. Even me, I know. Specific. Everything is there. Now let me continue. So I was saying that we have two types of cash flow. We have what we call real cash flow. I have what we call money cash flow. Money or normal. Now, when you say something is real cash flow, it is real because it does not contain inflation. Listen to me. If they say real cash flow does not contain inflation. I just hope somebody is jotting, but if you are not jotting, there's still material anyways. Real cash flow does not have inflation. It's zero inflation on it. There's no inflation on it. But when they say money cash flow simply means by that it has been inflated. Money cash flow, it simply means that what it has been inflated. So there's already inflation on money cash flow. Money cash flow has already been inflated. Real cash flow or normal cash flow, it has not been inflated. Now let me now move down. I'm still on inflation. Let me now move down to the cost of capital. You see, whenever you see I've mentioned what's the name now? I've mentioned the cost of capital. I mean, I've mentioned the cash flow, the real cash flow, and the money cash flow. Even at that, we still now have what we call what's the name? The real cost of capital and the money cost of capital. We have what we call the real cost of capital and the money cost of capital. So whenever you hear real cost of capital simply just means that it's a cost of capital without inflation. It simply means it's cost of capital without what? Without inflation. But money cost of capital is already inflated. It's still the same thing. Money cost of capital is what is already inflated. Now, let me now tell you another trick that that I can use to fail students. I told you that real cost of capital is a cost of capital that has been inflated, while real cash flow, it has not been inflated, while real cash flow is a cash flow real cash flow is a cash flow that has not been inflated, but money cash flow is the cash flow that has been inflated. Now, what I'm now saying is, whenever I want to discount, I'm trying to look for something. Whenever you want to discount a money cash flow, listen, whenever you want to discount a money cash flow has been inflated. Whenever you want to discount a money cash flow, you must discount a money cash flow with a money cost of capital. That is that's another place they fail students. If you want to discount a money cash flow, you must discount a money cash flow with a money cost of capital, and you must discount a real cash flow with a real cost of capital. On no occasion, listen to me, on no occasion should you discount a money cost of capital. Should you discount a money cash flow with a real cost of capital? I said on no occasion, on no occasion at all, should you discount a real cash flow with a money cost of capital. Now, okay, that grammar I just blew now. That grammar I just blew now. Let's put small figure to it. So you guys can understand what I'm saying very well. So now let's say okay, so what I'm saying is, so let's say we have something like this. So let's say we have year 0, we have year 1, we have year 2. Let me just use 3 years, please. Please, let's keep muted, please, I beg. So we have year 3. Somebody is not muted. Dion Shegun, please help me with your mic. Thank you. So I was saying we have year 3. So let me see, my year 0 is 200,000. People see that there is work here. This is just inflation. I've not done taxation. I've not done working capital. And I've not even solved question. And I was there doing accounting rate of return. People are not giving me wrong figure on top. So let me say this is this. Let me say this is this. Let me now say this is this. Let me now say this is this. Let me now say this is this. Now, what I'm not saying is, now they now tell you that.
Give me 10.
Which one give me 10? Okay, 50,000. So they now tell you that all these cash flows now, they are real cash flows. Listen, they now tell you that all these cash flows, they are real cash flows. What it means is they have not been inflated. This is what it means. So they have not been inflated. What I can now do for you, or another thing they can do, or this is what they usually do. Let me say, this is what they usually do. They will give you all these cash flows. Listen, they will give you all these cash flows. They will not tell you that, okay, they will not give you specific inflation that, okay, sales has increased by 5%, some has increased by 6%. So you would have discounted all of them. So let's not assume that after you've used all those inflated rates, after you've grown, I will be calling them growing. Like you are growing them. You are they say something has increased by 5%, you are growing it now. So you've grown all of them by 5%, you've grown one by 5%, you've grown this one by 3%. You now have this answer. This is what you have. This is what you have as your present value. It's your present value after you've done everything. What I'm now saying is, in your question, they will not tell you that real. If you take Pathfinders, you see there, they will not tell you that real cost of capital. They will not tell you that real cost of capital equals to 10%. Now, But it's students that not attend Apex, or students that not go for training, or that not go to good center, we just carry this 10% down and go and discount this thing. You will now come out, you say you finished ICANN, you have injured them. But don't know you have injured yourself and they have injured you too. Because you have already inflated this, the moment you inflated these cash flows, you already converted them to a money cash flow. But you are now discounting with a real cost. And I just told you that on no occasion should you discount a real cost of capital with a money cash flow. So what I used to advise my students to do is don't tamper with this, don't touch this cash flows, although you can, but don't tamper with this cash flow. Just come and convert, just come and change this cost of capital. Just convert this real cost of capital to a money cost of capital. Just come and convert this real cost of capital to a what? To a money cost of capital. Now let me give you an equation, although this equation also is in your material. So there's, I think it's Fisherman theory, the Fisher theory. I don't know who send the man work. All those men, they go don't die. They will not come and be giving us problem. But anyways, I think it's Fisherman theory, the Fisher theory, then the Fisher effect. Anyone?
Fisher equation.
Been on. So the man said that your 1 plus money cash flow, or money cost of capital multiplied by one plus I is in your material. This your M is saying your money cost of capital. This your R is saying your real cost of capital. This your I is your general inflation. They would have given to you. All these values will be in your question. So this real cost of capital, see it here, 10%. You just come and put this 10% here. Your inflation, they would have given you this I in your question. So your general inflation is 5%. Just come and put it here. So you will get your answer. Please, I went as far as, let me check if I did it for you guys, but I'm sure I did it for last diet people. But it's still the same material, so I'm sure I did it. Okay, see what I did. I even went as far as possible as bringing out what you will get, whichever you are looking for. If you are looking for your money cost of capital, this is what you will get. If you are looking for your real cost of capital, this is what you will get. And if it's inflation you are trying to determine, this is also what you will get. For some people that don't know how to do indices, and that don't know how to do subject or formula, you can cram it. But if you know how to do subject or formula, and you are sure of yourself, you can leave it and just cram only this one. So that you know that whatever you are looking for, you can know how to manipulate and get your answer in the exam. But if you know you are not sure of your mathematics, you went to Namina U primary school, Adigunjali secondary school, you know that's where you went to. Don't stress, just come and cram all of this like this. Know that if you are getting money cost of capital, this is what you have. If you are getting real cost of capital, this is what you have. And if it's inflation you want to get, this is what you will have. So you just put all those figures in this, then you now get your what? You now get your money cost of capital. So once you've gotten your money cost of capital, go and use it to discount that cash flow that was given to you, then move on. Then you've gotten your answer. Bye. Now, that about inflation. Please always assume, please, this one we are full of assumption. Please always assume that all the cost of capital given to you, they are money cost of capital, except otherwise stated. And all the cash flow given to you, they are money cash flows, unless otherwise stated. Listen, I'm not saying that in your exam, if they just say cost of capital, this is what I'm telling you. They just say cost of capital is 5%. I'm not saying that you should now go and start doing all these things and be calculating what they did not send you. If the examiner did not expressly tell you that real cost of capital equals to 10%, don't touch the cost of capital. Don't say Mr. Shele shaking it on. If the examiner expressly tell you that real cost of capital equals to 5%, you can come and change it. You can come and do all this magic and get your money cost of capital. But if the man just writes, or woman just writes cost of capital equals to 10, leave it like that. Because the assumption is that if it is not expressly stated, assume that cost of capital is money cost of capital. That's the assumption. But if it's expressly stated, you can now come and go and do all your mago for that. I hope there is no question with inflation. Now let me go to the third one, taxation. This one is also another very, very important part. Another very important part. Now, I don't tire. Anyways, another important part, taxation. Now for taxation, now you know that. How would I explain this one now? Taxation. Okay, let me do like this. Now for taxation now, taxation can either be tax can come and tax can go out. We know Abi. We can collect tax and we can pay tax. When we are collecting tax as a company, it's not as if it's not as if FIRS is paying us. So I say tax can serve as if tax can come in as inflow and it can go out as outflow. Outflow is normal when you are paying them. You are paying FIRS. But when it's serving as an inflow, you are not. It's not as if they are giving you money. Nobody is asking for your account number and sending you shish. But it's coming in as tax reduction. It's coming in as tax allowance. Here, allowance. It's coming as tax allowance. That is, it is reducing the amount of tax you are paying. Abi now. So that is where tax allowance is coming in. It's reducing what? It's reducing the amount of tax you are paying. First, you need to first know that one first. That there's something called tax allowance on capital allowance, tax allowance on capital allowance. So what I'm saying is, so if you do your tax, you do tax 10%, then capital allowance, tax on capital allowance can also be the same. Sometimes they differ. So you get that one. So you now use that tax on capital allowance to less the normal tax you are paying. I'll give you an example. Before I give you an example, let me explain some terminologies relating to tax for you. First of all, we have about 4 types of capital allowance. Listen, this is where some people fail. We have 4 types of capital allowance. People should have done this in taxation. First, we have initial allowance. Initial allowance is charged, is only charged once, and it's charged at the beginning. It's only charged once in the lifetime of the assets, usually. So it's usually beginning. Initial allowance, you charge it only once. The annual allowance is charged every year until you dispose the asset. Every year, annual. You'll be charging it every time, every year until you dispose the asset. Then we also have what we call balancing allowance. What we call it balancing allowance. So balancing allowance, usually, it is when your tax sitting down value when it's greater than your sales proceeds. When your tax sitting down value is greater than your sales proceeds. So you've calculated that you now have your tax sitting down value for the last year. You now get your sales proceeds. Whenever your tax sitting down allowance is greater than your sales proceeds, it's called what? Balancing allowance, and it's a profit. Balancing allowance is a taxable profit, please. It's a taxable profit. It's a taxable profit. But balancing charge is when your tax sitting down value is less than your sales proceeds. It is when your tax sitting down value is less than your sales proceeds, and it's a taxable loss. Balancing charge is when your tax sitting value is less than your sales proceeds, and it's a taxable loss. Please, this thing is very, very, how would I say, it's very dynamic. So people can tell you that. I don't want to confuse you. That's why I did not tell you the other way, but I will still tell you. People can tell you that balancing charge is when sales proceeds is greater than tax sitting down. So let me write it down so that people can understand what I'm saying. This tax sitting down value. I'm just letting you know the dynamic so that you will not say that somebody is teaching you rubbish in Apex. And students, people are very, very, very quick to decide without even knowing what is happening. What I'm saying is this. No, this is not what I'm saying. No. What I'm saying is this. You can still go that other way now, but let me use this one. These are they different? We are they different?
No.
No, sir. They are the same.
No.
They are the same, sir. So we know they are the same, Abi. So now what I'm saying is, if me I tell you that tax sitting value is less than sales proceeds, somebody somewhere can tell you that when sales proceeds is higher than or greater than tax sitting, that we are still speaking the same grammar. It's just English. So me, I just always like that you use the one that you know. Don't learn the two. Use the one that you know. And I feel like my own is easier because I'm putting tax sitting down value first in the two. Do you understand? Tax sitting down value for balancing allowance. Tax sitting down value is just that is for one is greater, for the other one is lesser. I mean, it's less. One is greater than the other one is less than. So I feel like it's easier that way. For balancing allowance, it's greater than sales proceeds. For balancing charge, is less than sales proceeds. Easy peasy. Balancing allowance is greater than sales proceeds. Balancing charge is less than sales proceeds. For balancing allowance, it's a taxable profit. For balancing charge, it is a what? Taxable loss. So let me go to method of calculating capital allowance. For method of calculating, we have straight line method, and we also have reducing balance, just like depreciation. We also have reducing balance method of calculating capital allowance. Now let me go to how to claim your capital allowance. How do you claim capital allowance? You can either claim capital allowance in the current year or in arrears. What current year means is tax of this year, you are claiming the capital allowance this year. Tax of next year, you are claiming the capital allowance next year. Capital of next 2 years, you are claiming. Do you understand? That's what in the actual year or current. You can see it in, they call it in the actual year or current year. Another one is in arrears. In arrears means that tax of year one, tax of year one, you will now go and collect. You will now go and collect the what's the name? You're not going to collect the capital allowance in year 2. Tax of year 2, you collect capital allowance in year 3. Tax of year 3, you collect capital allowance in year 4. Do you understand? So that is what in arrears simply means. So that is just basically the majority or major thing with taxation. Now, what else do I need to say here? I feel like when we start solving questions, people will understand better. And this is how I have like a structure on how to calculate capital allowance here. Okay, see it here. So this is how you calculate tax savings on capital allowance. Listen, this is how you calculate tax savings on capital allowance. So you first do your cost, which is your initial outlay. The capital allowance, what's the name now? This is like you doing your oh god, how would I say it now? Okay, let's assume that your depreciation or your capital allowance is 30%. Let's assume your capital allowance is 30%. So you first charge this your 30% on this cost to get your tax nominal value. You charge capital allowance on this your tax nominal value to get this. Then you now subtract this to get your sales proceeds. But that is not your tax savings. Are you listening? That's not your tax savings. That's just your capital allowance. So what you are doing is tax savings on capital allowance. Tax savings on, but this one, what you've got here is just capital allowance. So that same percentage, sometimes the percentage differ, sometimes it's the same thing, but most times it's the same thing. So if the same thing, you now come and charge your tax saving, you now come and charge it on this figure here, not on the tax down value. Now come and charge it on your capital allowance to get this figure. Come and charge it on your capital allowance to get this figure. Charge it on your sales proceeds to get this figure. So that's your tax savings on capital allowance. So that is also here. So lastly, okay, let me put small figure so that maybe you guys can understand what I'm saying better. So let me say I'm already wasting time. So let me say year 1, year 2, year 3, year 4. Let me put year 0. Should I put year 0? Let me leave year 0. So let me say I have let me bring this down. So let me call this operating. Are we still there?
Yes.
Yes, sir. Yes, sir.
Yes, sir.
Yes, sir. Yes, sir.
I already told you, there's no rest for the wicked. The Yorubas used to say, for people that don't understand Yoruba, I'm sorry. The Yorubas used to say, about this to say it. Pikin,
No,
English is how the Yoruba say. Pikin, a child that says that his mother will not sleep. Himself, he no go sleep. So people that say I will not sleep, now say I no go sleep. So we got that day. So if you say, okay, so let me do this like this. I hope this works. So I know it will not work. Oh, chin, I don't scatter this thing. Let me do it like this. This word thing is it's making my work very difficult. So let me do it like this. So let me see our operating before. So let's say this one I have 10,000. This one I have 12,000. This space will not contain. So for this one, let me say I have 14,000. For this last one, let's say I have 15K. For this one, let's say I have 15,000. So my tax, now let's say my tax is maybe, let's say 10%. Let me say tax at maybe 10%. The tax at 10%. So 10% of this. 10. So let's say for this one, I have 1,000. Abi, it's tax now, it's going out. So you say 1,000. Say 1,000. For this one, I have 1,200. Abi. For this one, I have 1,400. For this last one, you see the way I'm taking my time to explain this first step. No, it's not that one that when I now start solving question, people will now be doing how did we get this one? Where did we see this one? I better go. So I'm taking my time now. 1,500. So you now come here now. You now say tax savings. I'm even putting figure to it. The tax savings on capital allowance. Let's assume they say it's 10%. Please, another assumption or another thing, the way this one works. The year you charge your tax is the same year you charge your tax savings. What I'm saying is, in the question, we tell you that tax is charged on actual year basis. Please, your tax savings will also be charged on actual year basis. Because most times they will not tell you the way your tax savings is charged. If your tax is charged in arrears, please, your tax savings will also be charged in arrears. But if your tax is charged in actual year, tax savings will also be charged in actual year. If tax is charged in preceding year or arrears, your tax savings will also be charged in arrears. So tax savings is 1,000. So what I'm saying now is, if your tax savings is 1,000, so you will now say, okay, now if it's 10%, you know this 10% does not necessarily mean 10% on this 1,000. Listen, no, this 10% is not 10% on. You would have, this one is another working note. That table I showed you, you would have gone ahead to go and calculate this in that table I showed you. That table I showed you is for reducing balance. Let me go back. You must understand by for if it's for me to open your head and put it there, you understand. What I'm saying is this method is for reducing. You put now to do when we do depreciation now. This is mostly reducing balance when you subtract your cost from your residual value. That's the reducing balance. But when we do straight line, people will just divide the cost by the number of years now. So if that is, they will tell you they want to use in the question. They will tell you, but if they don't tell you, if you see cost and you are seeing maybe sales proceeds, residual value, you should know that that's telling you to use reducing balance. Now that one is not, it's not rocket science. If you not see residual value, know that you're supposed to use straight line. But if you see residual value or sales proceeds, know that you're supposed to come and use your straight line method. Anyways, what I'm saying is, so let's continue with what I'm saying. What was I even saying? Well, okay, so this one now you would have calculated this one somewhere. That's what I'm trying to say. You would have calculated your tax savings on capital allowance somewhere. Just what we calculated was 500. It can be the same every year. Let's assume we use straight line. Straight line will be the same every year. 500. And the last one, 500. So now what this simply means is, this one will not be negative. This one is coming in now. So this 500 now is lessened from this 1,000. So you're using this 500 to relieve this 1,000. This one, you're using it to reduce. Instead of paying 1,000 as tax, it's 500 you are paying. Instead of paying 1,200, you are paying. Instead of paying 1,200, you are paying 700. Instead of paying 1,400, you are paying how much is that? 900. Instead of paying 1,500, you are paying 1,000. So this tax savings is lessened from this one. Yeah. So that is that about inflation. Please all your questions, be writing them down. I don't want to hear. Please write them down. Last but not the least, working capital. Working capital. Please, what is the meaning of working capital? Now, whenever you hear working capital, first of all, this is the way I always explain working capital to people, and everybody I've explained to like that, they understood it. Now you have a business. Listen, you have a business. Maybe you sell, you do you do pre-order, or you do okay. Let me use our company as example, Vintage Accounting Solutions as an example. So when training comes, whenever it's time for training, we always get some amount of money to purchase the software, because we always give software to students. But for people that have been there, so we'll buy those softwares from QuickBooks. If you say you buy those softwares from them. We also do flyers, we do graphics, we pay graphic designer, we pay banner people, we pay, who do we pay again? We pay some of our staffs collect advance, like our IT team collect advance. to pay customer care. What I'm saying is some of all those money paid would have been gathering them now. So they are used for the running, working capital is used for working, they are used for running of the operations of the business. So okay, this one, I use this one to do this one, I use this one to do this one. So they are used for the running or the working of the business. It's called a working capital. So what it means is you're supposed to invest it, you're supposed to drop it for the, let's say the total money that will pay advance of the IT team, the money that will pay for graphic design, the money that will pay for everything is 200,000. So you're supposed to pay the 200,000, then we'll now what? Then we'll now recoup it back. When students start coming for the training, they will start pay now. When students start falling for the training, they will pay. So we have recouped it. You getting it? Let's say another year, another direct comes. We'll pay for those things again. After training, we'll recoup it. That is working capital. There are three major assumptions of working capital. If you want to write it down, you can write it down. Three important assumptions of working capital. There are more than, but three major assumptions of working capital. The first one is it is introduced at the beginning of the year. It is introduced at the beginning of the year. It is introduced at the beginning of the year. The second assumption is it is recouped. That is, it is gotten back. It is recouped at the end of the year. It is recouped at the end of the year. First assumption is introduced at the beginning of the year. Second assumption, it is recouped at the end of the year. Then last assumption, it is not taxable. Don't tax your working capital. It is not taxable. So you would have done everything you want. So usually working capital is usually the one you do last. Like after you've done everything line by line item. So working capital is usually the one you do last so that you will not tax it. It is not taxable. It is introduced at the beginning of the year. It is recouped at the end of the year. Then lastly, it is not taxable. So now, listen, that is for working capital. But there's a general assumption with investment appraisal. There's a general assumption. The general assumption is any cash flow, listen to me, any cash flow, either introduced or recouped, like either you introduce it or you get it back, either it's a cash outflow or cash inflow, it is always assumed that it is happening at the end of the year. Are you listening? It's always assumed that it is happening at the end of the year. So if they say something is year two, they say something is sales year one, year two, year three, you assume that you are, what am I saying? It's assumed that it is introduced or it is gotten back at the end of the year. That is the assumption. So anything you see is at the end of the year. So what? So some things. So sometimes we can tell you that they can tell you that something is happening. How do I say it now? They can say, I'm trying to look for a scenario, but it's not playing in my head the way I want it to play. So they can say, oh God of mercy. It's not playing in my head the way I want it to play. So I don't know how to put it down. But what you should know that anything introduced should be at the end of a particular year. So if cash is, let's say something is introduced at the end of, okay, let me say something is introduced at the end of year one or at the end of year two. When is it going to be recouped? It's going to be recouped at the beginning of year three. I hope this thing is making sense. If something is introduced at the end of year three, or if it's introduced in year three, you'll be recouped at the beginning of year four. Recoup means you are getting it back now. I don't know if that my grammar makes sense. So, but that is, I feel like that is the best way I can explain it. So if they tell you that, let's say you introduce I want to explain this thing. Let's say you introduce okay, let's say okay. I think I understand that. Okay, I know how to explain it. Now listen to me. You know that part of the assumption is that it is introduced at the beginning of the year. It is introduced at the beginning of the year. Now, when they say something, I just told you that anything that is introduced is always assumed to be at the end of the year. Anything is always at the end. But now this assumption is saying that working capital is always introduced at the beginning of the year. So what it means is, if it is introduced at the beginning of year one, that at the beginning of year one, it simply means year zero. Does it make sense? Because we are assuming it's because every cash flow needs to be at the end of a particular year. So if working capital is introduced year one, we'll take it to be year zero because this is my grammar loafer. But because what it is saying is the working capital is coming at the beginning of the year accepted according to his assumption. But normally, okay, let me give you an example. Let me put figure to it. Maybe you will understand what I'm saying better. Let me put a figure to it. So let me say let's say we say year. Let me say we say year 0. Yes, my year 0 is too close. Listen up. So let's say we say year 0, 1, 2, 3, 4, like this, Abby. Let's now say maybe we have let me see, use this my example that is up. Let me say we have maybe 100,000 here. So we'll just copy this thing like, oh no, I don't need the tax for anything. So let me see 100,000 here. Then we now have 10,000. Abby, 12,000, 14,000, 15,000. Listen up. So now they now tell you that working capital, because the question we say working capital is at 10%. Let's assume this is our sales. Let me put it there. Say sales. So they now tell you that working capital is, they don't say working capital at 10%. At 10%, 10% of sales. So 10% of 10,000 is what? Yeah. 10% of this is what?
1,000.
10,000.
Okay, hold on. Before I do that 1,000, let me put it a way that you understand. So let me come back down here. Watch you. Let me come back down here. You don't need to do all this one I want to do anyways, but it's just a way that makes you understand it. So it was somebody that taught me this method. Madam, I'm not muted. So let's now say so you now say what you now say beginning. Say beginning like this. Say beginning. Just like this. Say introduced. Abi. Now, what I'm telling you to do, this one you don't need to do it in the exam. Nobody has time for this one in the exam, but just to understand the basics of what I'm saying. So now, what is 10% of this? So they will now tell you that something was introduced. Is introduced at the beginning of the year now, but it's usually recouped at the end of the year. So this thing is 10% of sales. So if 10% of what's the name now? If 10% of if 10% of this 100,000, Abi, 10% of this 100,000. What's 10% of 100,000? That's 1,000. Abi, how much is that?
10,000.
That is 10,000. So year zero does not particularly have how would I say it? It's not as if it's not as if there's anything called year zero. It's just we're just using it to represent as at now. We're using it to represent as at now. So 10% of this is 10,000, Abi. So it's introduced at the beginning of 10,000. So let me put something here also. Let me put ending. Let me say I want to close. So let me say recouped. So this 10,000 naira now, you'll be recouped when? This 10,000 will be recouped. You'll be recouped you'll be recouped in year one. Why would it be recouped? It will be recouped in year one because I told you that it is assumed that it will be recouped at the end of the year. This is introduced at the beginning. This is recouped at the end of the year. So it's recouped at the end of the year of year zero, meaning it's still year one now. Let me continue. You understand what I'm saying? You understand better. Let me just continue. Hold on. So now this is for this. Now you now come now and now say, okay, year one now, 10% of 10,000. That's 1,000, Abi.
1,000.
So this is introduced at the beginning of year one, like this. is introduced at the beginning of year one. So you say 1,000. But this 1,000, if it's recouped at the end of year one, I told you that at the end of the year, it's still the same thing as the beginning of the year now. So at the end of year one is the beginning of year two. And this is telling you that you should always assume that this is beginning of year one. So this will now be recouped at the end of what? At the end of year two. So you say 1,000. Don't worry, you will not go through all of all this process when we start doing real work. When you start doing real work, you will not go through all of all this. Please, this is going to be in negative. You are introducing it now. Money is going out of your pocket. So you say it's going to be in brackets. So this is also going to be in brackets. So year two, 10% of 12,000. That's 1,200.
Yes, sir.
So this is negative. So you recoup this 1,200 at the end of year three. So 10% of 1,400, that's 14,000, Abi. But that's 1,400, sorry. 1,400. 1,400. Okay, you say 1,400. But let's continue anyways. Year 0 this, year 1 this, year 2, year 3, year 4. Okay. Yeah. So what's 10% of the last one, please? Oh yeah, 10% of the last.
1,500.
I think I've done rubbish. Sorry, I have noticed my mistake is this is shit. Where do I start from now? That thing will not. It will not. I think it's better like this. I'll explain again. Hold on. I'm sure I'm noticing that thing will not contain that thing. Don't worry, this is a step. This is not the way we'll do it next. This is not the way we'll solve our own. This is not the way we work. There's a simpler method we use. Now, what I'm saying is, or what we did. Sorry, I hope I never do. Okay. So what we did was, we are still using 10% of sales now, but the way this thing works is, this year zero leave year zero first. So this 10%, if we do 10% of 10,000 is 1,000. So what we are saying is, this 10% of 1,000, it would have been introduced when? It would have been introduced at the beginning of what? At the beginning of that year one. It would have been introduced when? It would have been introduced at the beginning of year one. This one I'm teaching is one method, but the method we use is not particularly like this. So let me finish this one. I'll tell you the method we use. Oh yeah. So this one so this one would have been what? 1,500, Abi? That I could tell.
Yes, it's 1,500.
Maybe I should have not taught people this method, but some people preferred it. I think some of my students last year actually like this method because they used it as a way of confirming their answers anyways. So you would have done 1,500. So this 1,500 now would now okay, this is negative. So you see 1,500 here. This one will not still work. I beg. Please hold on. Wait. What's it that? 1 minute, please. Let me do something. So let me come here. So this is 1,000. This is what? This is 1,2. This is 1,4. This is 1,500. So you see the difference is. So you see here. So here you see 100,000. 1,2 minus 1,000, that's 200. 14 minus 12. That is what? That is another
200. 200.
That's another 200. Sorry. Then 15 minus 14. That's 100.
100.
Then summation of everything together, that's 105. Abi?
Yes, 100,500 now.
100,500 now. Please let me clean. Maybe that's let me just use this as an example. This is even very good. It happened. You see something. That's why I always tell people to always study. Please listen to me. This is why I always tell people to always study. This method, this person taught me last night, and because I've not looked at it since, I don't forget. So this is the method we are supposed to be using. So let me clean this one, or let me cancel it. When I remember, I will go and look at it again. I need to go and put. I've not looked at it since that last diet. That's last year, maybe. So this is it. So listen to me. You know, I said that the three assumptions, it will be introduced at the beginning of the year, introduced at the end of the year. It should not be taxed. Another assumption is only the differences will be recorded. Like only the movement. What only the movement means is okay. Let me continue with that vintage accounting solution example I gave. So I said that let's assume that all the money for our software is about 200,000. So we now dropped 200,000 at the beginning of the year. So after the end of the year, we now made 207,000. What I'm telling you is what will be recorded is just the 7,000. That's the differences. Even if it's negative, it can be negative, it can be positive. So what we recorded is just 7,000. Next year we bring another 800,000. I'll be another 8,000. We introduced it. We now made we recoup 70,000. There's a negative 10,000. It's just that difference that you record. So that is what I did here. This is the sales that was given to us in the question. Working capital is 10% of sales. So 10% of this is this. Leave this year zero. 10% of this is this. 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 So you do all of them.
Sorry, sir.
I'm with you.
Yes, sir. That 10%, we are starting from year 1. So our numbers of years will now be extended to 5th year.
No. You're starting from?
We are starting from year 1. So if you want to do the incremental working capital now, so let's start from this year 1 now. Let's ignore that 100. So if we are not we have actually gotten the 10% of sales. Working capital is 10% of sales. We have gotten 1,000, 1, 2, 1, 4, and 1, 5. So to now get the incremental working capital, it will now be the first year, which is year 1. We have 1,000 naira. It will be negative. For the second year, which is year 2, we will do 1,000 minus 1, 2. That is 200. For the year 3, same thing, year 4. And at the end of the year, the final one, we will need to extend these numbers of years by 5th year. It will not be that last amount, which is that 1,500.
Exactly. That is exactly what you do. So this is, for people that don't understand, this is what it's trying to say. So it's saying that normally the way this thing looks, this thing looks, please hold on. What it's trying to say is with the way this thing looks, there will be year 5. That is what it's saying. Okay, now let me put because this. Okay, let me do another. Please hold on with your question, please. Let me make sure this thing is very, very clear. Let me make sure it's very, very clear. Let's do something. Let's say how would I say this now? Okay, let's do it like this. I'm trying to look for a befitting example that can work for us. Okay, let's do it like this. Let me just cancel these ones. Let me cancel these figures. Let me just cancel these figures. So let's say you know that when you do your total sales, the total sales cannot start from year 0 now. I feel like that is what is confusing on everything here. When you do your total sales, I'm sure that's where some people are confused. When we start, the total sales cannot have year 0. Yes, now let me show you that. Okay, I think that's where people are missing it. Let me show you something. See what we have here. This is the way it looks like. This year zero. It's just our initial outlay. But from year one is where the sales will start from. So let me now come here. Let me now go back to that our working note. So if you come here, you say sales. Watch you. So you come here. Let me put another figure. Let me say you have 30,000. Let's say now we have maybe let's say maybe we have 86,400. Let me come here now. Let me see. Maybe we have maybe 20,000. Maybe no. Let me increase it. Let me see. Maybe we have 100,000 or 200,000. So let me see. We have 300,000. Watch what I'm doing now. So now, so this is your sales. So let's say let's say maybe they are supposed to increase by come say maybe I don't know, incremental sales. Let's say maybe okay, let's say this is our incremental sales. We've increased the sales. Don't let me start from there. Let's say we've increased the sales. This is our total sales now. So now let's now do our working capital. Let's say our working capital is maybe it's 10% of this thing. Let's say working capital. Working capital at 10%. So what's 10%? Let me just. So what's 10% of this? So this is 8,000. This is 8,640. Have we? This is 20,000. This is 30,000. Now listen to me. Listen to me. This is what our working capital. Eh? This is what our working capital is. Now let's now do the differences of the working capital. Then this is what our working capital is from our sales. This is what our working capital is. But let's now do normally what we could have just done in some situations where they don't give us some situations where they don't tell us to do the 10%. We could have done the differences from here. That is subtract 86,400 from here, 200,000 from this from this. That is, they did not tell us that our working capital. When we start solving questions, I think you understand better. I think you understand better. In some situations where we are not supposed to, did not give us the percentage. We just come and subtract this from the. But anyways, for this one now we have percentage. So let's say when I say working capital. So now I told you it's only the movement now that you will record. Abi. So now what's for the first one? We have what would that be?
3,000. Negative 3,000.
3,000. 3,000 will come from
3,000.
Will be years.
So this zero. So this one minus this one.
To create a year zero.
So 8,000 minus 3,000.
Minus 5,640.
5,640. Yeah.
Minus. The first one also is negative.
11,360.
Negative. Do you understand why we are getting negative? We are subtracting 3,000 from the other one. You know? So 5,640. This other one come.
Minus 11,360.
Minus 11.
Negative 11,360.
Then
This one.
10,000. 10,000.
Negative 10,000. Sorry.
Yeah.
Now, listen, this is a working capital. But now when you now want to put these things into years, no, this is not the way, this is just calculation. But this is not the way your work looks like. So in your work now, you have something like this in your book. So you would have had, so in your book now, you have year zero, you have year one, you have, let me put space. So you have year one, you have year two, you have year three, you have year four, you have year four. This is what you would have had in your book, Abi. So you would have had something like this in your book. So you now come here and now see this 3,000. Now I do all this one now. What this means is all at the end of this year, all this amount. By that time, these are the amount that have been recouped. Now they will now be introduced, they will be put at the beginning of the year. So this means that This now means, so if you bring this 3,000 goes to year 0. So that is negative.
Sorry, sir.
Negative 3,000. Please hold on, please. This is negative 5,640. This is what? 11,360. Abi? This is 10,000. And at the last year, please let me add everything together.
You should give us 30.
30,000.
What you now have at the end of the year. Please, at the end of the last the total will always be at the end of the last one. No,
we should have 50 year.
It should be a 50
Don't
year.
have year 0. It should be 50 year.
there should be a year 5.
Year 5, yes.
There should be a year
I don't think
5.
there should be 50th year. It should end up in 4th year since we have year 0.
No. We'll have a 50. There will be a 50 year. You see, yeah, let me tell you something. Listen, just listen. Listen to me. All these things are vague. I know. They are vague because the questions are not starting from beginning. So we don't have a very clear picture of what it looks like. You know what I always tell you, don't panic, just relax. So you start solving questions and we start putting figures to it. Believe me, you understand. I just want you to understand the basics of what we are doing. So when we start putting figures and these figures they are created for my head. So it might not look very well the way it's supposed to look. But when we start solving questions and we start attempting them, I'm sure you understand. But this is just basically what everything looks like. This is just basically what it looks like. But don't worry, don't panic. We already have, how many questions do we have in our question bank? Let me see. So on this we have question, so we have question 3. This assignment, that's 2. We have another one. We have 3 questions. This is another one. We have about 4 questions. 5, another one. Before we solve all these ones, I'm sure you understand what we are trying to do. So don't worry, don't panic. When we come, I don't know if where's the lecturer will come. So if he's going to be around, fine. If he's not going to be around, maybe I'll be the one to take it. But anyways, any which way, I would let you know. So when we start putting figures to it, I'm sure you understand. Anyways, those are the 4. More time has gone. These are the 12 here. So those are the 4 things that are actually very. Let me put start to this working capital because I know most of you don't understand what happened here. But so I will know that. So I will put more emphasis on it when we in the next class. Anyways, if people that want to ask me a question, please ask me. So I'm very tired. Yeah. So please raise up your hand if you want to ask me anything, please. Yeah. Salam, Akorede, you want to ask me something?
Yeah. Thank you for your time, sir. So I just want to quick one. When you are trying to explain inflation, we have general and we have specific. My question is, in a situation whereby the question states growth, what is the correlation between the growth and inflation? I know they are actually different.
They're distinction.
For example, let's say they said growth is expected to, sales is expected to grow by, let's say, 5% annually. And we also have, let's say, general inflation in the question. It is different from having inflation is expected to occur on sales by certain percentage, and there's difference between sales itself growing by a certain percentage.
Okay, let me correct something and let me add something.
All right, sir.
What you actually said is they are practically the same thing. When they say sales go by 5%, it means that's been inflated by 5%. The growth and the inflation they are practically the same thing. But the only difference with what you asked is in that question, it has specific inflation and it has general inflation. So if they tell you that sales has grown by 5%, variable cost has grown by 5%, in that same question, looking down, they now give you a figure for general inflation. Watch out what they are doing. What they are doing is, if you watch out that question very well, what you have in that cost of capital, it will be a real cost of capital. That question, the question will have a real cost of capital. That is, they assume that your cash flow, because of those grow by 5%, it has been inflated, and the cost of capital they are giving you is the one that has not been inflated. Some students will take that cost of capital and go and discount it, but it's wrong. You're supposed to use that general inflation given to you to now go and use that formula I gave you earlier. Although they will give you cost of capital also, that cost of capital here. You will now go and take that one, use that formula I give you to determine what? To determine the real cost of capital. And determine the real cost of capital, you're not going to use it to discount that real cash flow. When they say something grew or something has been inflated, it's the same thing. The only difference is that question gave you specific inflation and it also gave you general inflation.
All right, thank you, sir.
Is it clear? Does it make sense?
Yes, sir.
Okay. Luciana Obot, you want to ask me something?
Yes, sir. Good evening, sir.
Good evening, ma'am.
Please, I have some questions there. One is that fisher equation that you gave us, 1 plus R, 1 plus inflation. Please, that inflation rate, should it be the general inflation rate that I'll put in there in the inflation formula?
Yes, ma'am.
Okay, so that's clear. Then, for tax savings on capital allowance, I think I didn't understand the last lap there. How you got those other figure. I didn't understand how that tax savings. Then another question I have is interest payments. You talk about the interest payments. You said you talked about that it's irrelevant cost. Please, is it because we are using it as a discount factor or what? I didn't get. Okay, because it's my pen. You said that it's not relevant because you have used it as a discount. Is that the reason why it's irrelevant here?
Yes, that's the reason I said.
Okay, thank you. Then
You
please
guys have
go back to.
You guys have done work now. When you do work, maybe you do cost of debt plus cost of equity. That cost of debt there, when you're doing cost of debt, before you time that cost of debt, you would have done IRR, internal rate of return. So when you do, that's our bond valuation now. So when you do that bond valuation, you would have used interest. That interest is the cash flow. You know, you're doing IRR now, you first use initial outlay, you now use cash flow. So that cash flow is the interest. So you'd have used it then. So you cannot come and use it now again. Oh, yeah, this 12 a.m. What did you say I should go to, madam?
I think I asked you a question on tax savings.
I don't know where you said I should go to.
That tax savings that you calculated, the one that you gave us with numbers there, at some point I got.
I've deleted it.
And I didn't write it out.
It's just, I've deleted it. Let me see if you can come back. Oh, little long. Okay. I see it here. What's the problem? Yeah, madam.
Even mute. Okay. Oh, sorry. I didn't know that I didn't unmute. Please, this your tax savings on capital and 10%. How did you? I thought you are going to do 10 minus 1 and this thing before you now get the difference. Then you now tax on it.
I'll do 10 minus waiting.
Size 12. Oh, let's close.
I'll do 10 minus what?
The tax, the first tax you had before making it 9% before you now do tax saving, or is it cost minus residual value divided by? Is that I didn't
understand what you're saying now. Which figure are you trying to get?
This 500 here. This 500.
I just assumed now. I just assumed this figure had not do anything.
Even when it's assumed, there's something you said that time before you now assume. You now talked about how you got it through straight line or reducing balance. So I didn't get that. That's like.
I don't know, maybe when we solve questions, but I'm sure what I said here was the fact that I said you can either do it two ways, either you use reducing balance or straight line. So I'm just assuming this is straight line and assume the figures. And I said if it's reducing balance, the figures will be different. But because it's a straight line, that's why the figures are the same. And there's a table in your material that asks if you are doing reducing balance. Don't worry, when we put figures and when we start attaching it, you understand how to do all these things better. And when we start putting figures to it, you understand how to do it better. But I just assume this 500, it was not coming from anywhere.
Okay. Thank you.
Please, I'm just assuming, or I hope there's no any question for me anymore. I am gassed. I am tired.
Me too.
It probably you that you want to write the exam, you are tired. Miss Funke, please ask me. Yeah, please fast.
Good evening, sir.
Good evening,
Thank you for your time. God bless you, sir. My question is on the earlier asked question on specific and general inflation. But in case we are giving specific rates and general inflation, if you have already used the specific, does it mean that our cash flow is on morning cash flow?
If you are giving specific what? Sorry.
Specific inflation rates, I've already applied to discount our cash flow. Does it mean that when we already calculated the cash flow, we've already calculated the morning cash flow?
That's the meaning now. If you inflated it, it means it's not a morning cash flow.
Okay, sir. Thank you, sir.
The moment you put inflation on any cash flow on a real cash flow, it becomes a morning cash flow.
Okay, sir. Thank you, sir.
I hope that question is answered. So I think that's the last question I have anyways. This wasn't easy. Anyways, so now this is what we'll do. So I owe you guys 2 explanations. Okay, one self, but which is more explanation on working capital. So what I will do is maybe tomorrow I will look at that method that person taught me. Will be this one in the morning at 12 a.m. So what I'm saying is I'll look at that method that person taught me. I will bring it also so that we can compare that to this our own. So that whichever one you like or whichever you want to pick, you can go for it and pick the one that is comfortable for you. So I'll look at it again and bring it to class. Then this other one, but by then would have put figures here. I just wanted this class to explain. So by then we'll now come and put figures, we'll start solving questions. Then I think we'll move on. So if I were you, what I would advise or what I would want anybody to do is the first question in the question bank, attempt it. I'm not saying do it though. If you do it, you can send, but just try to solve something. Just try to crack your head, or to rack your head. It says not crack. To rack your head on something. That's the first question. I think the first question is still the simplest. So this is the first question. Based on all my explanations, just try something on it. This is the first question. This number 3 is the first question. And this is the method that we will use for our investment. This is it here. This table. So first increase our sales, we increase our variable cost, we increase our incremental fixed cost, we get our tax, we get our profit. After our profit, we get our normal tax. Then we get our tax savings on capital allowance. Our scrap, we less our initial outlay. This is where we less our initial outlay. Then this is where we less our working capital. Then net cash flow, then our discount factor. Then we get our present value, then we get our net present value from there. So I'm sure anybody can just put your pen to paper, try something. So either I see you guys on Wednesday or I see you next week Monday. Have a wonderful night chest. Please don't forget, you can text me on my other number, not on my number is in the comment section. Please don't text me on my personal number, only if you want to tell me personal things. But please text me under my other number for anything you want. Anyways, thank you guys very much for joining. Have a wonderful night chest, and I will see you either Wednesday or Monday. Good night, everyone.
Good night, sir. Thank you so much, sir.
Welcome.
Good night, sir. Thank you so much.
Good night.